Okay, I see our numbers are still climbing very rapidly. Welcome everyone to the session. I think we've got lots to cover today, so I think in the interest of time, we'll get started. We have over 300 of you here with us live now. I'm sure more will join, but without further ado, I'll hand over to my colleague, Anthony Miller, the SSE Chief Coordinator, to kick off the session.
Thanks very much for that, Fiona. It's great to see everybody joining. The number's still going up. Welcome, everybody. We have registrations today from 116 countries for this workshop. So thank you all for taking the time to join us today. This training session that you're about to participate in is a collaborative effort between the United Nations Sustainable Stock Exchange Initiative, the IFRS Foundation, ISSB, the International Sustainability Standards Board, and the IFC, the International Finance Corporation, as member of the World Bank Group. This is very much a demand-driven thing. We have been training participants all over the world, over 15,000 participants last year alone. So we welcome all of you, and we appreciate your excitement and interest in this topic. You're not alone. People all around the world are very interested and excited about these new standards and how to learn to apply them in their marketplace. So I'd like to start by introducing and inviting our colleagues from the IFRS Foundation to make some comments. We're very privileged to have with us today Elizabeth Seeger, who is an ISSB board member. We don't always have ISSB board members on every training, so I think the audience is privileged today to hear from you, Elizabeth. Elizabeth, you have the floor.
Thanks, Anthony. I really appreciate it. And welcome, everyone. I am truly delighted to join to kick off today's interactive workshop session. I would like to extend my sincere thanks to our partners at the Sustainable Stock Exchange, as well as at the IFC, for their ongoing commitment to supporting the implementation of the IFRS sustainability standards around the world, much of which is represented in the discussion today. It's really exciting to see. So I also want to thank the participants, which is all of you, for making time to be here. This is a particularly critical time for collaborations and shared learnings, as market participants from around the globe are just starting to implement the sustainability standards. In fact, currently 35 jurisdictions have announced that they are adopting or taking steps to adopt the IFRS sustainability standards in their markets, which collectively account for approximately 60% of global GDP. For those of you who don't know, since 2023, which is also the year in which our two standards, S1 and S2, were published, the ISSB and the Sustainable Stock Exchange have been co-delivering trainings just like this. And I am both impressed and thrilled to share that we have seen a very strong uptake, with approximately 13,000 participants trained across over 40 sessions. And these sessions have been hosted by multilateral bodies and exchanges globally, with approximately 50% taking place in emerging markets and developing economies. So why is training like this important? High quality, comparable, sustainability related financial disclosures are really essential for investors to be able to understand the sustainability related risks and opportunities that could affect a company's prospects. And importantly, this is not just about the quantity of information that is provided, but also the quality of that information. And for companies, the IFRS sustainability standards seek to reduce the complexity of the reporting landscape by reducing the competing expectations for disclosures for companies around the world. But it is also important that the standards that support this information are proportional in nature, meaning that they are adaptable for companies' particular facts and circumstances. The IFRS S1 and S2 standards provide a global baseline to achieve all of these goals, both for investors and companies and financial markets more broadly. But despite being built on many existing standards and frameworks, including the international accounting standards that are used or permitted in over 140 jurisdictions worldwide, in many ways, this is a new language. And so trainings like this one today are truly critical for building an understanding of the standards and confidence in their applications. And stock exchanges and partners such as the IFC play a pivotal role in enabling the application of the standards around the world. So in closing, I want to thank you all once again for your participation. We hope you find this session useful and helpful and look forward to your feedback. Thank you so much.
Thank you so much, Elizabeth. I'd like to also invite our partners from the IFC. We have with us Chuck Canfield, who's the Global Corporate Governance Manager. Chuck and I, I've had the privilege of working with Chuck for almost 2 decades now.
Yes.
And Chuck is a driving force at the IFC on issues of corporate governance. And of course, a big part of corporate governance is transparency. So Chuck, can I invite you to give us a few opening comments?
Certainly. Thanks so much, Anthony. It's really my privilege to welcome all the participants to this important global session on the IFRS sustainability disclosure standards. On behalf of IFC, I'd like to extend our truly sincere appreciation to our partners from the IFRS Foundation. Thank you, Elizabeth, as well as the UN Sustainable Stock Exchange Initiative, which has been our partner for a long time. Your support in delivering this event is invaluable. We at IFC, we are the largest developmental financial institution working in the private sector in emerging markets. We have offices in over 140 countries. We operate in some of the most difficult and challenging markets. And we've learned, especially in the area of corporate governance, that global standards, often designed for developed markets, require a phased approach and this proportionality that Elizabeth mentioned. We also know that we need to have capacity building to help translate these standards into local context. So regulation needs education. And this training, applying the ISSB standards, is a step in that direction. And a result of our partnership with both IFRS and UNSSC. And I think I'm going to repeat again, Elizabeth mentioned that we've trained over 13,000 participants in more than 25 markets in applying these standards. And this is very important because to this end, today's training focuses on a deep dive of IFRS S1 and S2. And these standards mark a pivotal step towards globally consistent language, a common language for sustainability-related disclosures. Since these standards became effective back in January 2024, 36 jurisdictions have moved to either adopt or are taking steps to introduce these standards. And that's pretty significant because those markets represent 60% of global GDP and 40% of global market cap. The ISSB standards reflect increased sustainability and climate reporting requirements. They urge regulators and stock exchanges globally to adapt their listing and reporting requirements to meet investors' demand for complete and accurate ESG data. The standards also affect supply chain companies in emerging markets and developing economies, which need to provide reliable, comprehensive, and verifiable sustainability and climate disclosures. Over the past year, our IFC Beyond the Balance Sheet program and our advisory services have worked closely with the IFRS Foundation to support regulators, stock exchanges, and importantly, companies and financial institutions in emerging markets with the adoption of IFRS S1 and S2. We worked in companies like Bangladesh, Jordan, Kazakhstan, Peru, Pakistan, South Africa, Kenya, Nigeria, and others. And this was only possible through a 2024 Memorandum of Understanding between IFC and the IFRS Foundation. Lastly, I'd like to introduce you to the Beyond the Balance Sheet platform of IFC as a valuable resource. You can find the link in the chat, and it contains training materials and actually has a step-by-step toolkit for preparing reports that align with ISSB standards, as well as some other sustainability disclosure standards. It also has a self-assessment tool, which allows companies to benchmark their practices against these standards. Additionally, it has e-learning and a number of other resources, including examples, that's freely available to anyone who wants to access it. We continually update the platform and encourage you to explore it. And it should be able to help you in your journey towards better sustainability reporting. We think that today's session will strengthen your understanding of these standards and support you in your work on your journey. Thank you so much and enjoy your learning today.
Thanks a lot for that, Chuck. And now, without any further ado, I think it's time to dive into the training itself. And for that, I'd like to hand over to my colleague, Fiona, who is the SSE Academy's lead trainer, and she's going to take us through today's agenda. Fiona.
Brilliant. Thanks so much, Anthony. And thank you again to Chuck and Elizabeth for setting the context for us so well there and for the continued collaboration between our organizations. So as Anthony said, I'm going to be leading the training from the SSE perspective. I'll just talk us through a few housekeeping points on the agenda here before I introduce the other speakers we have joining to deliver the training. As you've noticed, we've got a busy panel, so we've got lots of experts here to join you today. So hopefully a great opportunity to learn and ask your questions. So as you'll have probably noticed by now, everyone is muted. However, we do want to really encourage you to continue to participate in the session by using the chat function to share any introductions or any general comments, but making sure if you have a question for the team to use the Q&A box in particular. That just ensures that we can keep track of and answer those questions. As you can see, the chat moves quite fast, so make sure you use the Q&A box if you have any questions for the team. And please do make sure you're using that opportunity to ask your questions. We have many experts here today who'll be well placed to answer your questions. So in terms of the format for today's training, we do have a 3.5-hour live session. I think I saw someone ask the question. We will have a short break in the middle of the session. You'll be pleased to know. We do know it's a long time to concentrate for, and you will likely benefit from a quick refresher in the middle. So we'll be having that live Q&A throughout, as I mentioned. Please do make sure to ask those questions. You can also upvote any questions that you see that you think would be good to have answered to make sure that we're prioritizing those that are most popular. So feel free to make use of that thumbs up function as well. And we do really ask for and hope for your participation in the session. So we'll be introducing a few different forms of interaction in the session, including Menti for some interactive exercises, as well as having a number of Zoom polls. So please do participate in those. It's great to get your input and makes the session more exciting for all involved. So we'd love to have your participation there. And finally, just to mention, you will be eligible to receive a completion certificate for taking part in the training. To receive your certificate, you'll need to join us live for the full training, and we'll share the details with you at the end of the session as to how you can access that certificate following a feedback survey. So stay tuned for more information about that at the end of the session. Okay, now to introduce who's going to be delivering the training. So I'm joined by my colleague Lois on the SSE team, who'll be delivering the SSE content in the training. Hi there, Lois. We also have Bella and Robert from the IFRS capacity building team, who are going to be speaking from the IFRS perspective. And both teams are joined by colleagues who'll be working in the background as well to answer your questions and participate in the chat. So thank you to Landon from the SSE team and to Vanessa Huimin Hui and Neil from the IFRS team who's supporting with questions as well. Okay, so to kind of cover off some other key points, we're going to be covering 3 key learning objectives in today's session. So firstly, we're going to be starting with helping you to understand the ISSB standards. We're then aiming to help you to understand how you can use the standards. And finally, we'll be thinking about how you can identify what steps to take to develop a disclosure plan to apply the ISSB standards. So to help us meet those 3 learning objectives, we've broken this training down into an agenda that hopefully simplifies this. So we have 4 core modules that you'll see in the circle screen there that we're going to be working through during today's session. So those in turn are Prepare, which is all around building on existing knowledge of the reporting landscape and thinking about the global baseline that the ISSB standards have set. We're then going to be coming through into Align, which is all around setting the direction for your disclosures. So thinking about how you can apply and use the standards and what additional disclosures they might require versus what you might have been reporting previously. Then in our third module on Implement, it's all about practices and systems. So how do you identify, evaluate, and integrate those sustainability risks and opportunities into your business processes? And then finally, we'll come on to Communicate. So thinking about the final format for your reporting and the location and timing of those disclosures. So keep in mind this structure that we're going to be working through throughout, and that'll help you to know whereabouts we are in the session. And here you just see a quick agenda which breaks that session structure down. It shows obviously we've got quite a large amount of content on module 2, so that takes up quite a chunk of the session, and that short break that we have in the middle as well to refresh. So we're going to be talking about a lot of different resources in the session today, and we'll be sharing lots of links in the chat with you as we go through. A particular link we'd recommend that you look at, and hopefully one of my colleagues can just share momentarily now, I think it's already been shared, but we'll share it again, is the link to the SSE webpage for this event. And that's where you can find the slide handout from today's session so that you can follow along and look at any of those links that you'd like to in your own time. And also you'll find the homework exercise on that page, which we're going to be talking about later in the session. So if you go to the resources section of that web page, which we'll be sharing a link to in the chat shortly, you'll be able to find those resources. Also following the session, you'll be able to access a recording of the training from the same location indeed. And as I mentioned, we'll have a homework assignment. This is entirely optional. It's really just to help you to continue to build on what you've learned from today's training. It's not mandatory to do this or to submit it to us in any way. But again, you can find that homework assignment on our webpage at the link shared in the chat just by Lois there. And that's really something that we'd encourage you to use with your colleagues internally to continue to build from what we've covered today. And a few things just to highlight, there's a whole toolkit of resources you can access on the SSE's website to help you across various aspects of this reporting. So you can access this from the slide materials on that webpage or using that QR code you see there. So we'd recommend taking a look at those things as well. But we'll be talking about lots more specific resources as we go along. But before we do, I just have a quick Menti interaction to get us started using Menti for you first of all. So the link will shortly be shared in the chat, so please do keep an eye on that chat there. I know it does move quite fast when we have a big group, so please make sure you do scroll back up and check the links if you're needing to find something we've talked about in the session. But Lois has just shared the link to Menti there. And what I will do is I'll also share screens with Menti now, and that'll give you some further options to access Menti as well. Okay, so if you are looking at the screen there, you can see a QR code, which you can use to access Menti as well, if you prefer. And there's also at the top of the screen, the option to go to menti.com and enter that 8-letter code that you see at the top of the screen. So 3 different ways to join us there in the Menti. I'll just give you all a second to do that. But our first question for you is really just to share with us in your own words, a couple of key aims that you have from today's session, why you might have joined us. So I'll give everyone a minute just to get in, test that out. Lois has just shared the link again to you there. So that's the direct link that you can follow if that's easier. And we do encourage you as well to keep this window open in the background throughout the training, because we're going to be returning to use the same link at different points to do some more exercises. Okay, so I see lots of words coming through already. We have knowledge, sustainability, understanding, development, application. Great, lots of ideas. So of course, we hope we can help you with all of those kind of areas. So you're in the right place indeed. So brilliant. I see lots of people still joining, but that's just a quick warm-up question. So we'll move on to our second question as well for you there, which is good to answer. So this question just asks you to give us a view on your current level of understanding across these different areas here. So you'll see here that we have those 3 different learning objectives that we talked about in the training. And what we're asking you to do is just to let us know on the left-hand side, maybe you're not comfortable in these areas at all at the moment. On the right-hand side, maybe you're already quite comfortable in some of these aspects. So just give us a quick indication of where you're at in your current understanding in these areas, as that's, I think, useful framing, and it's something we'll come back to later in the training as well. Okay, so I see from those who've responded, most people are sort of on the middle to lower end of their comforts on these different topics yet, which of course is very understandable. Of course, that's why we've joined and holding today's training. So Yeah, that's very useful to understand. So feel free to keep voting on that in the background. But thanks for letting us know. And that just also tests that we can all access Menti as well. But we'll be returning to that later in the session. So I'll take us back into the slide presentation now to move into the next segment. Okay, so before we start any content, just a quick disclaimer that I need to share just to get this across at the start of the session. So really what we want to do with this disclaimer is just be clear about how we're using examples in the training session. So we'll talk about different company examples, and these are very simply here to help add some color to what we're talking about. So sometimes we know it can help to see a real example and put that into practice in the discussion. However, examples shouldn't be seen necessarily as the best or the right way to do something. Of course, that's going to be very unique to your organization's circumstances, and you need to do what suits you best. So just something to mention at the start as we go through the session. Okay, with that established, I'll now be kicking us off with the first module. So as I said, module 1 is really all around building that solid foundation. So thinking about what you might already know about sustainability reporting, like the standards that are already out there and the frameworks that you might have been using already. So here we like to cover 3 particular aspects that are important. So we talk about purpose. So this is making the case for sustainability reporting and what the business market case is for this. Secondly, we're going to talk about landscape. So this is all about how the reporting landscape has evolved and including how it's becoming simplified. And then finally, we'll be talking about the global baseline. So introducing the core concepts and requirements of the IFRS S1 and 2 standards that form this global baseline. Okay, so then to get started, we'll dive into a little bit about the purpose. So before I share a little bit with you on that, I'd like to get a sense from you all as to what, your purpose is with your reporting and what your key drivers are. So I'll just launch a quick poll that should appear for you on the screen now. If you can't see the poll for any reason, do feel free to share your responses in the chat as well and let us know your answers to these questions. But the ask here is to let us know what your reasons are for disclosing sustainability-related information. Okay, so I see responses coming in very quickly. We're now up to over 700 of you live with us in the sessions. That's fantastic. So I see lots of you taking part already. I'm going to move quite quickly through these polls just to keep the session moving. So I'll end the poll there. Sorry if you didn't get time to participate, but we'll have lots more opportunities to do so. And then I'll just share the results with you. So we can see that for 70% of you, regulatory requirements are an important driver here. And we're also seeing particularly investor interest from over half of you as quite a strong driver as well. And then finally, we see a mix, of course, of some of you who maybe want to also share your own objectives. Maybe there are social or comparator expectations for doing this. Or of course, some of you might just be starting your reporting, and of course, that's fine as well. But overall, it looks like regulatory interest and investor pressure or interest in this topic is your key driver. So thanks for sharing that. So I think that aligns well with what we typically see for this. And of course, investor interest is something that we wanted to start with because we do know that this is often a very strong driver. So here we're just sharing the number of signatories that we have to the principles for responsible investment. And we're now up to over 128 trillion US dollars in assets under management that are signatories to these principles. So it's fair to say, I think we've seen quite a significant growth in investor interest in sustainability. But what is it that's really driving this? So I think what's important to highlight here is that a key driver behind this investor demand is the financial effect and financial relevance of this information. So here we've got a study from retail investors, which was done by Morgan Stanley. And here they found that the top driver, at least for these individual investors, for considering sustainability was all around financial performance. So you can take a closer look at the study in the handout if you'd like to, but really what we want to get across from this is that interest in sustainability by investors isn't something that's niche, it isn't about altruism necessarily, it's really about the relevance and increasing significance of these factors for financial performance. And so I've started using that term financial performance, and it's important to remember today we're going to be talking particularly about financially material sustainability information. And so we're going to discuss in more depth in the workshop what that word material means, but we wanted to be clear from the start what sort of financial effects investors are looking to have more information on. So here let's start with the effects on a company's performance. And this is often seen in the statement of profit or loss, which shows your income or revenue and expenditure. And sustainability-related risks and opportunities can have a financial effect by changing, for example, the revenue mix or total revenue of a company, if demand for its products and services might change, or if production capacity is disrupted, for example. And we can also see substantial changes in expenditures. So if, for example, operating costs increase due to energy prices increasing, or if there's a need for greater R&D expenditures to capitalize on sustainability-related opportunities. Or, of course, there might be costs associated with deploying new practices as well. So those are just some examples of where we can see how sustainability risks and opportunities can start to impact on financial performance. And you're probably also going to hear us talk today about effects on a company's financial position. So let's look at what that means as well. So we can often see a company's financial position on their balance sheet, also known as their statement of financial position. So for example, a company might experience changes in certain assets or liabilities due to climate or sustainability issues. We might also see changes to portfolio value, or we potentially could even see write-offs of certain assets that are damaged or need to be repriced. And another financial effect that should be documented is changes to financing and the cost of capital. And that can include, for example, insurance premiums that might increase due to climate risks, as well as making use of new financial structures such as green bonds or social bonds. So just a few key terms we thought were important to establish. But before we move into the next unit, I just wanted to flag as well two really important aspects of sustainability-related risks and opportunities, which are really essential to our understanding of them and our disclosures. So as you can see here from the latest Global Risk Perception Survey from the World Economic Forum, which you're probably quite familiar with, risks do evolve over time. So whereas something might be a particularly material risk in a 2-year time frame, of course, what might be material over a 10-year or longer term time horizon could be quite different. And so what's important for our disclosure is that if we're going to be prepared for that risk that we're expecting to arrive maybe 10 years from now, we might have to invest today in new practices or processes to mitigate negative impacts or realise opportunities as well. And so what we might need to keep in mind there is that those financial effects that we discussed could indeed occur earlier than the risk itself if we might need to take some action now to manage that risk. And another important aspect of sustainability-related risks and opportunities is their interconnectivity. So this is another visual coming from that WEF risk report. And as you can see here, there are many interconnections between different risk types. So whereas many people might think of those two ISSB standards, S1 and S2, as separate topics, climate and other sustainability, of course, in practice, we see that sustainability risks and opportunities are inherently interconnected. And so separating one topic or theme doesn't remove these connections. And of course, we need to consider the whole when we're making strategic decisions. So in disclosing information about climate change in accordance with the S2 standard, it's also important to apply those requirements that we see in S2, S1 as well, insofar as they relate to the disclosure of climate risks and opportunities. Okay, so that's just a few key concepts established that hopefully will set us up well for the rest of the training. And with that, I'd now like to hand over to my colleague Lois, who's going to be taking us through the landscape segment.
Thank you, Fiona, and hello, everybody. So Fiona's explained why sustainability disclosure standards are important, and I'm just going to have a quick look with you about how the standards have evolved within the current landscape. Before we do that, though, can I ask you what frameworks are you currently using? The Zoom poll will appear on the screen shortly, and we ask you to select all that apply. So are you using CDP to report, the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, or the UN Global Compact Principles, or any others? So please let us know if there are others in the chat. We can see that there are people using the European Sustainability Reporting Standards, the BRSR, the Sustainable Development Goals, the IFC standards, the TNFD, lots coming through. So thank you for all those that you're putting in the chat. Now we have over 50% participation. I'm going to end the poll and share the results. And you can see the majority of you, 66%, are using the Global Reporting Initiative standards. And that's followed by the recommendations of the Task Force on Climate-Related Financial Disclosure, some of you using Integrated Reporting and ISSB 2, some using the UN Global Compact and the SDGs. Thanks ever so much for letting us know that. It's very helpful for context. So let's move on and look at the organisation that created the standards we're looking at today. So it's the IFRS Foundation, which is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting disclosure standards. As you see at the bottom, there are two independent standard setting boards. The International Accounting Standards Board, this was formed in 2001. It sets accounting standards and they're in place in over 140 jurisdictions around the world. The International Sustainability Standards Board, established in 2021, as Elizabeth told us, they issued their first two standards in 2023, following strong market demand. Now, governance of these independent standard setting boards who work very closely together is provided by trustees, and they in turn are accountable to a monitoring board of public authorities. So Elizabeth mentioned earlier that the ISSB standards were based on standards that were already in existence, and this screen shows you the logos of some of those organisations, and I'm sure you are familiar with them. But far from a picture of confusion, what we see from the arrows here is a picture of simplification and harmonisation. That's the main message to take from this screen. Some organisations like the Integrated Reporting Foundation and the ISSB were consolidated into the IFRS Foundation, and their work forms part of the ISSB standards. The TCFD's work has been taken into the IFRS Foundation, and the TCFD's finished its work. The disclosure materials of the Transition Plan Task Force are now under the responsibility of the IFRS Foundation, and CDP has aligned its climate questionnaire with IFRS S2 on climate disclosures. So a lot of alignment and consolidation there. With GRI, the ISSB is firmly committed to jointly identifying and aligning common disclosures. With GRI, there's a memorandum of understanding. They work very closely together. So let me ask you another Zoom question here. There's only one answer you can select, either true or false. And the question is, companies who disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or is this false? We give you a moment to think about that. We'll wait till we've got 50% of you. Sorry, we go through these a bit quickly because we've got a lot we want to tell you today. There we are. We've got over 50%, so I'm going to share the results with you. 55% of people say it's false and 45% say it's true. Well done to 55% of you who got this correct. It is false. You cannot automatically assume that if you use the TCFD recommendations at the moment, you automatically comply with the ISSB. And this is because there are a few differences between them, which I'll explain in a moment. But the good thing is, if you are using the TCFD recommendations, you are a long way towards having everything you need for ISSB conformance. So let's look at that in a bit more detail now. So on the left, you'll see a little thumbnail of a report that's been done by the ISSB showing the exact differences between S2 and the TCFD recommendations. But really, there are just three types of differences. The first type is that S2 uses different wording from TCFD, but really to mean the same thing. The second type of difference is that S2 sometimes requires more detailed information, so might need more information on the use of carbon credits, for example. And the third type of difference is that S2 has some additional requirements. And an example here would be S2 requires companies to consider sector-specific standards when considering their risks, opportunities, metrics, and other things. So three types of differences there. So the ISSB's main objective was to set a global baseline for sustainability disclosure. So the global baseline sets a common language for sustainability information, and it means that companies prepare comparable and consistent disclosures across global capital markets. And the ISSB is working with jurisdictions around the world to support that global baseline. However, they recognize that regulators, stock exchanges, and others might wish to add requirements to that global baseline, which we're calling here building blocks, so building on top of the global baseline to cater for jurisdiction-specific or stakeholder-specific information. The sorts of information that go beyond the remit of the ISSB, and these could include information commonly requested by the GRI, for example, to meet wider stakeholder needs. But taking this building block approach reduces the need to duplicate information by having that globally consistent baseline of disclosures, while still allowing you to report additional information based on standards like the GRI standards. And you can do that provided that the information is presented in such a way that it does not obscure the information required by the ISSB standards. Just to mention quickly, because we're just slightly behind time now, that there's global backing for the global standard that's represented in the ISSB standards. So IOSCO, the International Organization of Securities Commissions, has asked their 130 members around the world to consider how they can incorporate the ISSB standards into their regulatory frameworks. We have new assurance standards from the International Auditing and Assurance Standards Board that supports assurance against sustainability disclosures. We've already heard, I think Elizabeth said, 35 jurisdictions around the world are adopting or taking steps to adopt the ISSB standards. And there's also events like this one and this type of training to support organizations that voluntarily wish to apply the standards. So I'm going to hand over to Bella now, who's going to start to explain the standards to us. Over to you, Bella.
Thank you so much, Lois. So let's continue with the next slide. Yes, now we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. Okay, so as we start, it's important to note that there are some key terms that should be understood. You can find definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. In terms of sustainability-related financial information, it is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. So what do we mean by sustainability-related risks and opportunities? They are risks and opportunities that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You may know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. So now anyone familiar with TCFD will recognize the same four core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the four content areas today, but I encourage you to download the standards as part of your homework assignment. So it's time for IFRS S1 General Requirements. So its full title is General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. So if you are familiar with TCFD, you will see the same architecture applied throughout the standards. S1 asks preparers to refer to and consider the applicability of the ISSB standards and the other sources of further guidance to identify sustainability-related risks and opportunities, and identify material information. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements. The scope of S1 is all sustainability topics except for climate, which is covered by S2. So the second standard S2 focuses on climate disclosures, building on the same foundations of S1. So for example, it fully incorporates the recommendations of TCFD. And it also sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And also it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, this include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. And also preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. Okay, so S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. IFRS S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. Okay. So next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And the reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and connections between sustainability-related financial disclosures and the main financial statements. Okay, so now it's time for an example. Over to you, Lois.
Thanks, Bella. And just this is our first example today, just to remind everybody of the disclaimer that Fiona gave earlier, that we show you examples really for illustration, for colour, for inspiration, rather than to suggest that the examples are correct or represent best practice. They're for your inspiration. So this is an example that is designed to show you how companies make disclosures about connected information. And this is an example from BHP's annual report. And BHP is a global mining company, mining and resources company. This is an extract from the operating and financial review section of their annual report. And it's part of the disclosure this company makes about how they manage climate-related risks and how they plan to transition to a net zero economy. And the extract is describing the impact of the company's climate-related risk assessment, as well as their scenario analysis on the business and capital allocation plans. You can see in the first paragraph there, they're talking about the effects of climate assessment and their 1.5 degree scenario assessment. Now, the connection here is that they tell us in that first paragraph that climate risk assessments and the scenario analysis are integrated into the company's strategy and treated as a sensitivity in their capital allocation process. So this means they can test the connections and alignment between the company's capital allocation plans, their own decarbonisation plans, and the rapidly decarbonising global economy. The extract also tells us that there are some assessments already that are still in progress. So they're sort of connecting us to the things that they're already doing. And one of those things is that they're undertaking studies to assess the effect of future physical climate-related risks on the company's operations, productivity, and costs. They're going to use those results to inform and therefore connect with the company's risk profile, corporate planning, control, controls and adaptation measures. So we're connected there to information about what's ongoing and what they intend to do with the output of that. Then we've got some light pale grey text at the bottom, and this tells us where we can find connections to further information on the impacts of climate-related risks on operational activities, greenhouse gas emissions across the value chain, on the financial statements, on production, revenue and expenditure. So this extract is just one example amongst many others in BHP's report about how the effects of climate change are connected with decisions and plans about standard business processes, operations, risk, controls, investment and finance. Back to you, Bella.
Thank you so much, Lois. Yeah, after looking at an example on connections, so it's time for a Zoom poll. Yeah. So still remember what we talked earlier is about connections, and the question is about connected information. What information should be considered for connected information? So is it connections between governance strategy, risk management, and metrics and targets, or connections between sustainability-related financial disclosures and financial statements, or connections between sustainability-related risks and opportunities? And this is a multiple choice question, so just to choose the answers that you think correct. Okay, so let's wait for a few more seconds to get more answered, get more participation. Okay, so we've already over 15% participation. So I'm going to end the poll and share the results. Yes, as you can see from the results that 65% have chosen option A and 56% has chosen option B and 52% option C. So just to remember what we talked before the example, that we have three aspects in terms of connections. So all of the options are correct. I think over half of us, answer the questions right. Okay, so let's continue. Okay. So finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured could reasonably be expected to affect investor decision-making. Okay. During the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and the case studies provided by our partners. The ISSB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated, with more planned to come. I should also note that IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the ISSB training initiative is one of our most important deliverables. Okay, so another Zoom poll. So let's do some exercise. For this Zoom poll, the question is, water is a vital input to your business. But the ISSB standards do not currently have a specific standard on water. What do you do? And just remind that this is single choice, which means only one answers should be selected. Okay. So let's wait for a few more seconds. Yes, now end the poll and share the results. Yes, we have 59% participated, and as you can see from the results that there are 87% choose the option B, and which is correct. So for this question, the option B is correct. As water is a vital input to your business, means water-related information is your material information. And one the ISSB standards do not currently have a specific standard on water, so the IFRS 1 points to other sources of guidance, especially those listed in IFRS 1. And apparently, option A is not correct because water is material information, so you can't disclose nothing about water. And maybe you may find it helpful that for option C and D. So, but for this question, only option B is correct. Okay. So maybe it's time for Module 1 summary. Over to you, Fiona.
Brilliant. Thank you so much for that, Bella. And as you say, that brings us to the end of our first module. So before we wrap it up, we just want to take a few minutes to review what we've covered. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we hope that you'll leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. So if you're not aiming to make good use of the data that you're collecting to improve your strategic decision-making, you're going about this wrong, ultimately, and you're potentially wasting your time. If you have operations in difficult to abate or high impact sectors, your competitors could likely already be disclosing these risks and identifying opportunities. And that's going to leave your investors wondering why you're lagging behind. And that ultimately could start to affect your ability to raise funds. And next, we looked at the evolution of disclosure standards, the formation of the ISSB, and the aim to simplify the landscape. And when you're thinking about other voluntary disclosures, you shouldn't see them as competing with the ISSB standards, but rather building on top of them. And finally, we introduced the standards and the important concepts you need to understand in order to use them correctly. And a key point I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors, and therefore they're heavily focused on those financial prospects that we discussed at the start of this unit, relating to financial effects and financial position. Okay, so that's a quick summary, and I'm now going to take us back to Menti, as some of you have already spotted, to do a quick exercise to wrap up this module. So I'll ask I think Lois has indeed just shared the link again to Menti with you in the chat there, so please have a look at that, and I'll also share screen in a minute to give you some further options to access Menti. What we wanted to wrap up in our first exercise is thinking about what your objectives are overall for your sustainability disclosures. So we think this is a really important thing to get clear on at the outset of reporting and building that disclosure plan. Why are you doing this? You know, being clear on what you're trying to achieve and what requirements it is that you're trying to meet with your reporting. So that could be to align, of course, to the ISSB standards, but it could also be to meet the needs of different stakeholders or to meet specific jurisdictional reporting requirements as well. And what we want to also think about here is, you know, where are we now in our reporting and where do we want to get to? So just take a moment to think about those points, and then it would be great if you can share your thoughts with us in Menti. So I'll share screen now so we can start to see some of those responses that you're thinking of. So this is really just a moment for you to reflect on your own organisation. And we should say as well that there's a strong link between these exercises we're doing together now and those that feature in the disclosure plan homework exercise that you can take away from our webpage. So if you start your thinking through these exercises, that should really help you to build out that disclosure plan. Great. So I see lots of people have already shared their responses, which is fantastic. Thank you. So let me just scroll through and we'll talk about a few of these together. So I see people have said around aiming to reduce their carbon emissions and increase efficiency. Absolutely, that's a fantastic objective to have from this, not just reporting information, but really taking action on that insight as well internally to drive benefit. So being transparent, of course, transparency and accountability, I see there, these are really fundamental to building trust with your stakeholders and having good governance arrangements. So definitely key things to keep in mind. And then we have maybe attaining more clients. Yeah, interesting. So certainly having better disclosure and transparency about your sustainability practices certainly may be attractive to clients who build that into their selection criteria. So strengthening your own research, yep, no problem. So integrating a bottom line approach, companies have a responsibility towards planet and people and prosperity. It's very nicely put, and I think always a good thing, of course, to keep front and center as we're thinking about these topics. I see lots of people have mentioned transparency again, maybe managing risks and opportunities, thinking about playing a part in conservation, providing more information to stakeholders. So lots of really good ideas there, I would say. I think most of those are definitely things that we would have highlighted to you as well. But I think what we'd really just encourage you to do is to be clear on what your organization's objectives are, to discuss that with your stakeholders, maybe discuss that with your leadership team. Probably write it down, because actually having that clarity over what you're looking to achieve here can be really important to come back to and connect as a good North Star. And it's great to see that a lot of you here in your responses are thinking not just about that external transparency, but really how you get internal benefit from this information as well, which of course we really encourage you to do, because if you're going to go to all of this effort to collect this data, actually using it for your internal decision making, improving your efficiency, reducing costs, etc., managing risks is really key. Okay, I see loads of great responses here. I wish we had time to go through all of them, but I'll leave that there for now for you to have a look at. But thanks everyone for continuing to share your thoughts with us. It's super useful to get those insights and just to see those different perspectives on this topic. So that's really helpful. Okay, so that brings us, as we said, to the end of module 2. So I'll just share screens again now, and I'll hand back over to Bella, who'll be starting us, on module 2. That was module 1 we just finished. Thanks, Bella.
Thank you, Fiona. So let's continue with module 2. Okay. Yes, now we have introduced the initial concepts. Let's dive into how to apply the ISSB standards, taking into account additional disclosure, including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. In order to understand how to ensure your disclosures meet global standards, we will look at 2 key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosures fit. Okay, to begin with, let's focus first on how to apply the ISSB standards as the global baseline. Yeah. Let's get started on the first core content, governance. This includes aspects that relate to the governance body in your company and how management is applied. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and the procedures of sustainability-related risks and opportunities. And for example, is management responsibility delegated to a specific role or committee? And another question you can ask is how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And you can also ask whether progress against these targets links to executive remuneration. For more information, you can make use of the ISSE checklist tool. But remember, it's not a replacement for reading and using the full ISSB standards. Okay, so I'm going to hand over to Lois for another real-life case. Lois, please.
Thanks, Bella. And here we have an example, everyone, from a company called Yara. And Yara is a global crop nutrition company. They're headquartered in Norway, 17,000 employees, and they operate in 60 countries. Now, this governance example and this model is particular to Yara, is reflected in their 2024 integrated report. And it's up to each company to decide how they adopt a governance process. But in this particular case, we can see that Yara has a highly integrated model with responsibilities for sustainability embedded across a number of business functions, including risk management, health, safety, environment and quality, human resources, and global climate and energy. We see those in the middle box there. The sustainability governance team are right over on the left-hand side in the first panel. They have a direct reporting line to the chief financial officer, whose responsibility is responsible for sustainability, performance and reporting. So we can see, how the individual functions report into the chief financial officer, and also how he reports into the board. So the arrows are used to show how information flows and how there are inputs between different parts of the structure, different parts of the governance bodies in the organization. So yes, an integrated model there. Now let's move on to look at an example from Toyota Industries Annual Report 2024. So as I'm sure you know, Toyota is a manufacturer of cars, including hybrid electric vehicles. So very keen to establish its environmental credentials. Now this extract provides a number of details. First of all, the frequency with which the Sustainability Committee meets once a year, as usual or as necessary. Who chairs the committee? So we can see it's the executive in charge of enterprise risk and compliance management. We can see who the members of the Sustainability Committee are, and also that they are from a wide range of disciplines within the organisation, so cross-functional membership. And we can also see at the bottom there the actions taken by the Sustainability Committee to approve action plans, to determine the direction of the approach to sustainability that also captures the opinions of stakeholders and social trends, and to keep their sustainability policy updated. So in Yara, we saw the responsibility was to the CFO. In Toyota, we see the responsibility is to the executive in charge of enterprise risk and compliance management. Up to the company to decide. And I think I'm handing to you now, Fiona, to take us into strategy now.
Indeed, that's right. Thank you for that, Lois. So that moves us in, as we said, to look at the strategy aspect. Now we've hopefully got governance reasonably clear for you. So strategy does have more disclosures to include than governance, but it's also really where companies can start to see the benefits from sustainability related risks being managed better and also capitalizing on opportunities. So as you can see here, there are 3 high-level areas that we focus on in strategy. These are risks and opportunities, effects, and resilience. So we're going to talk about each of these in turn now. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability-related risks and opportunities. So if we first look at the requirements relating to sustainability, risks and opportunities, these are some of the questions you'll want to be asking internally. So when disclosing information about risks, information required includes the description of the effects, the time horizon under which those effects are expected, and keeping in mind that those financial effects can occur before the risk or opportunity materializes, as we talked about at the start of the session, looking at those different risk time horizons. And of course, those effects can also change over time as well. And the last 2 questions on this list in particular look at climate. So this aligns with the requirements from S2. So for example, investors also want to understand what types of risks or opportunities are considered. And often we see companies using the categories that have already been identified by the TCFD here, such as physical and transition risks. We'll talk about that in a bit more detail later. But both standards include guidance to support companies to identify and disclose risks and opportunities. For example, the recommendation would be to make use of industry-based guidance and the ISSB standards. And we're going to be talking a bit more about some of where those resources are located towards the end of the session. So we know, again, this can often be easier to understand with an example. So let's add a little bit of colour here and see what this could look like in practice. So this example is from Mondi Group's 2024 integrated report. So Mondi is a multinational packaging and paper company with operations across Europe, North America, and Africa. And in the left-hand extract here, we can see which risks and opportunities the company has identified and how those risks align with 4 key categories. So strategy, financial, operational, and compliance risks. They've also identified the delegated risk owner for each risk as well. And you can read a lot more detail, we should say, for all of these examples in the report. So these are just some expert excerpts to summarize key concepts, but we do recommend reading the detail around these as well. And so climate change in the strategic categories risks are then further analysed in the second extract, and these are categorised as both physical and transition risks, as well as opportunities. So as well as identifying the risks through evaluation processes that they describe in the report, Mondi shows the estimated financial impact ranges, the time horizons between these different risks, and they also differentiate. You might be a bit small in the diagram, but we recommend looking into the report at the page referenced. They also distinguish between when they expect the risks to start and when they expect the full extent of the impact to be felt in the time horizon, which is quite useful as well. And then they finally talk about the sensitivity of these risks and opportunities in terms of their likelihood under different climate temperature scenarios as well on the right-hand side. So a useful way of summarizing quite a lot of information in these visuals, I hope you'll agree. And we started to touch on it there, but another aspect of risks and opportunities that will need to be disclosed brings us back to what we were discussing at the beginning, so time. And as you might remember, we discussed earlier that the time factor is something that can be quite different when we're talking about sustainability related disclosures. So let's make sure we're clear on what we mean by time horizons. So the standards ask you to identify within what time horizon any material effects are expected to occur. And what is defined as short, medium, and long-term time horizons can vary between companies, and it will depend on a number of different factors. So, for example, this could depend on your investment and business planning cycles, your strategic planning horizons, maybe the lifespan of your assets, or even some other factors as well. So what's important to remember here is that the time horizon does need to be defined by you. So don't expect investors to know what short, medium, or long-term means unless you provide them with a clear quantitative definition of how you're using that within your organisation. And you can look to some of the disclosure examples that we're sharing today if you want some considerations about possible time horizons that you could use. Okay, so let's move on now to the second group of disclosures in the strategy category. So the first section of the strategy component related to identifying those risks and opportunities. And now this next set of disclosure requirements focuses on what exactly that effect is and where it occurs in the business. So to start tackling these disclosure requirements, companies might want to start asking themselves questions such as beginning to describe these effects and understanding the responses planned for mitigating or adapting to the effects. And again, we think an example is probably quite helpful to look at here. So let's have another one. So this example comes from BASF, which is a global chemical producer, and this is from their latest annual report. And it illustrates some of the projects that form part of the company's sustainability strategy called Winning Ways. And this strategy includes supplying customers with products that contribute to sustainability through the use or reduction of carbon emissions as well. And so the company's prioritizing projects where they see rising demand from customers and a willingness to pay more for sustainability products as well. And among other things, the company is investing in renewable energy to operate their plants. And you can see that in the own production column there of their extract. They also talk about triple S in the right-hand side there in the downstream. And this refers to their sustainability solution steering, which is all around streamlining their company's portfolio and supporting their global sustainability targets. And in related commentary in their report, the company also talks about wanting to achieve higher sales revenues from sustainable products and how they're targeting the transition along that direction. And so overall, I think what's helpful from this example is that it illustrates how the company's sustainability strategy affects the business model and the value chain. So you can see there how they're looking across both their upstream, their own operations, and their downstream, and thinking about the connection that they see across these areas for different risks and opportunities. So sometimes one of the obstacles companies can face when they're reporting on these effects, however, is what detail should be disclosed. And in that example that we just looked at, we were showing mostly qualitative disclosures and descriptions. But what about quantitative disclosures? So a company is required to disclose both quantitative and qualitative information about financial effects of sustainability risks and opportunities. However, the ISSB standards do also set out criteria for when only qualitative information is required. And so using only qualitative information for these current and anticipated financial effects is permitted for a number of reasons. And this can be if the company can't separate the effect of a climate risk or opportunity from other effects, if there's a high level of measurement uncertainty, and additionally, it's permitted if the company doesn't necessarily have the skills, capabilities, or resources to provide that quantitative information yet. So the encouragement is really to endeavour to provide quantitative information where it's available and feasible, but with some of these reliefs around the possibility of providing qualitative information where needed. So that now brings us into the last part of the strategy component. So as a recap, the first part was looking at those risks and opportunities. We then talked about what the effects are on the business from those. And now this final group of disclosures looks particularly at how the company is preparing for uncertainties and ensuring its resilience into the future. And so this really gets into the practices and processes that a company has in place to assess its own resilience and make strategic adjustments. So disclosures here will include information on what types of assessment are used and how scenario analysis in particular is employed. And at the heart of it, resilience disclosures ask the company to disclose, firstly, its assessment of climate resilience and the inputs and the key assumptions that have been used to inform that. And so we're going to dive a bit deeper into scenario analysis in a moment, but some of the questions that you can consider asking internally when you're starting to disclose this information will focus on what the company's capacity is to react or adjust to those uncertainties arising, and how different scenarios are being used to test that. So fundamentally, when you think about a risk or an opportunity and those effects, how ready are you at the moment to respond to that issue? And is there more that needs to be done to assess that in more detail? So here's a few more examples again for this area. So here we have Stora Enso, which is a Finnish and Swedish forest products company. And they show us in this small diagram what their sales are likely to look like in 2030. So Stora Enso distinguishes between its essential and its growth businesses. So they have the sort of foundational sales from their existing operations in forests, pulp and wood, but also the projected growth in sales they're going to see from these strategic areas around sustainable building solutions, renewable packaging and biomaterials innovation. And so we don't have any set numbers against it here, but what it does really provide is that picture of how they're setting out a long-term vision and how they're expecting to transition and grow from these new business areas and activities. And in the second example we have here, which is Solvay, a Belgian multinational chemicals company, we're using this to illustrate how they've reported on the financial effects, in particular from their climate risks and opportunities. So here we want to highlight how they are transparent about the estimates and the notes that they provide on how they've developed scenario analysis. So if you're using a tool like scenario analysis, investors need to understand how you've used it. And you can see in this excerpt that they note what some of the assumptions are that they've used, including looking at areas around cost changes, volume changes, and the adaptation potential that they might have. And they've also highlighted that they've worked with external consultants as well to develop this. And then in the second excerpt we see here, they've also reported on the projected financial impacts for different risks and opportunities. So they've done this under both a 1.5 degree and a 3 degree scenario. And they've used a sort of qualitative scoring range here, running from -3 up to +3 to show overall what the potential direction of financial effect will be and the magnitude of financial effect from different transition risks. So this potentially could be a helpful approach to start with when you're developing these disclosures and perhaps you don't have certainty or access to full quantitative information. Perhaps a qualitative scoring approach like this could be something that you could consider. Okay, so that brings us around now to another poll, which I'll just launch for you. So our next poll question is looking to just check what you heard from me earlier about that point on qualitative and quantitative information. So you can select more than one right answer here, but you just need to select which you think are valid reasons why a company might choose to disclose only qualitative information and/or a combination of quantitative and qualitative information about financial effects. So either when they can't separate those effects from other effects, when there's a high level of measurement uncertainty, or finally, when the information sheds a negative light on the company. So I'll give everyone a few more seconds just to read that. I know that's a slightly complex question. We don't want to close it too soon, but we like to keep things fairly quick fire with the polls. I see lots of you voting, so I'll give it another, let's say 10 seconds to get your responses in. And don't worry if you don't know the right answer. That's why we're here to train as well. Okay. I'm just getting up to that 50% threshold we like to reach, so I will end the poll there and share the result. So as you can see, the majority of people have picked the top two answers and less people have selected the third one. And that means the majority of you are indeed correct. So the first two options there are indeed both options, which might mean that you need to disclose qualitative information or a mix of quantitative and quantitative. However, that final option around information that sheds a negative light on the company is not a valid reason not to disclose quantitative information. Indeed, it's important to be transparent and balanced in your reporting to your investors. And of course, if you do have quantitative information that helps you to see a possible negative financial impact, it's really important that you are providing that transparency. And we saw in that example from Solvay there just before this slide that indeed that they were disclosing both negative and positive financial impacts there. So I think it's important to say that is expected, and indeed, if you don't disclose something, it doesn't mean your investors are going to think it doesn't affect you. They'll just think that you're not thinking about it yet. So important to keep in mind that that transparency is valuable as well to share with your stakeholders. Okay, brilliant. So that brings us to the end of that segment, and I'm now handing back over to Lois for the climate-specific aspects of this area.
Thank you, Fiona. Well, as I'm sure those of you who've read the standards will have noticed, the governance requirements in IFRS S1 and S2 are very similar. They don't really have additional specific requirements for climate. However, when disclosing information related to strategy, there are some additional requirements in S2 that are specific to climate. So let's take a look at those now. So here the title is From TCFD to ISSB, but don't worry, if you haven't followed TCFD before, this list applies to your S2 disclosure. So the disclosure requirements in IFRS S2 are broadly consistent with TCFD, but the things to note are that S2 requires a company to refer to and consider the applicability of industry-based disclosure topics, which are set out in industry-based guidance. And this industry-based guidance is something companies are required to consider and refer to when working out what risks and opportunities they need to disclose, because they might be in the disclosure topics within the industry-based guidance. And also when it comes to looking at metrics and targets, which we'll look at later. S2 requires information about where in the business model and value chain risks and opportunities are concentrated. So is there a particular operation that's affected, or a particular location, or a specific part of the value chain? When describing the effects of climate-related risks and opportunities, S2 requires a company to disclose information about how it's responding to or plans to respond to the identified risks and opportunities, whether it has a transition plan, we're going to look at that in a moment, and whether it's got any climate-related targets that respond to the effects of climate-related risks and opportunities. S2 sets out the criteria for when quantitative and qualitative information is required for disclosure of current and anticipated financial effects of risks and opportunities. Now, this is one of the more difficult aspects of disclosure, but you'll be glad to know that the standard sets out the circumstances in which a company only has to disclose qualitative information. So an example would be where the measurement uncertainty is so high as to make any quantitative information not useful, you can just use qualitative information to describe the financial effect of the risks and opportunities. Now, again, when realizing that some aspects of the standards are difficult to apply, the S2 says that a company is only required to use all reasonable and supportable information available to it at the reporting date without undue cost and effort, or to use an approach that is commensurate with its circumstances in particular, in relation to particular requirements. And we're going to talk about this a bit more later on, about this so-called easement that means you don't have to go to a great deal of undue cost and effort to collect information if it is not currently available. Now, some of you have asked about this in the chat. Does the standard specify how many scenarios or which scenarios are to be used for climate-related scenario analysis? No, it doesn't. That is for a company to decide based on its own circumstances and based on all reasonable and supportable information it has available. And also S2 requires a company to make disclosures about how resilient its strategy is and its business model are to climate-related risks and opportunities. And when making disclosures about its resilience, its business resilience and strategic resilience, disclosures should explain any significant areas of uncertainty considered by the company. What is its capacity to adjust and adapt to risks and opportunities, and how much more resilient does it make the company? And also requires disclosure of how and when and what scenario analysis was carried out. So let's look now at transition plans. I just mentioned that a transition plan may form one of the ways in which a company responds to climate-related risks and opportunities. But what is a transition plan? Well, that's defined in S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, and it can include, for example, greenhouse gas emissions reductions plans. So as an aspect of the company's overall strategy, if we go to the first bullet point here, bear in mind that the transition plan must be aligned with the company's strategy, business case, and business motivation, and also reflect the decarbonisation levers that are most economically and technologically feasible for the company, so that there's a connection, an integration, and alignment between the climate transition plan, the business strategy, business case, and business model, and other motivations. The transition plan should also be aligned with science, so it should take account of what science says about the requirements for net zero to be achieved, or how carbon neutrality or Paris-aligned goals are explained and to be achieved in terms of the science. The plan should set out long-term transition goals that are accompanied by activities, targets, mitigation and adaptation activities, and interim targets and milestones to achieve those long-term goals. Of course, the transition plan will have to take account of all of the uncertainties that surround the transition in terms of the timing and effect of climate risks and policy changes, for example. So the plan should be transparent about the dependencies, risks, challenges, uncertainties associated with the transition plan, and also how residual or unabated greenhouse gas emissions will be treated. The transition will proceed in different ways for different sectors, and therefore it should be helpful to look at sector-specific pathways that are set out by different organisations, as they will inform the development of the company's transition and its transition plan, and we'll look at some resources that help with that in a moment. Finally, be conscious about how the transition plan is going to be evaluated by others, and that there are resources that set out the hallmarks of a credible transition plan. So let's look at some resources now. There are loads, there are lots and lots of resources. We can't cover them all here, but we just want to cover 3 types here because they are all interrelated. The triangle on the left-hand side shows how the work of the Glasgow Financial Alliance for Net Zero, or GFANZ, and the work of the Transition Plan Task Force, which is now part of the IFRS Foundation insofar as it covers disclosure, all these 3 things are designed to align and support each other. So let's have a think about the GFANZ, or Glasgow Financial Alliance for Net Zero resources. You can see in the middle of the screen that they have some resources that set out sector pathway and company type pathway expectations. So there is a resource on real economy transition plans and the expectations of them. There's a resource on financial institution net zero transition plans. And there's also a sector pathways set of guidance. On the right-hand side, we see the transition plan task force disclosure framework. And again, I mentioned that the IFRS Foundation has now assumed responsibility for transition plan disclosure resources. So these will be on the ISSB Sustainability Knowledge Hub that we're going to tell you about later. So you can see that there are a number of resources that can help. There are many more alongside this. So we're about halfway through now. We're going to take a quick break. I'm sure you'll be glad to hear. So we'll start the timer in a moment, 5-minute break. You'll hear some relaxing music. Take this opportunity to have a stretch and a drink, and please keep asking us any questions that you have. We'll see you back here in 5 minutes. Hello everyone, welcome back. Hope you had time to have a drink and a stretch, and we're going to go straight on now into the next core content area, which is about risk management. So as you can see from this high-level description, the disclosure requirements ask you for information about the processes that you use for risk management and whether they are integrated into the company's overall risk profile. So having a look at this in a bit more detail, we can see that this is a different type of requirement to the other ones we've looked at. The other requirements have asked us about what is your government, what is your governance structure, what does the board of directors do, what's your strategy, etc. What are the risks and opportunities? This particular requirement is asking you just about the process and the policy that you use to identify, assess, prioritize and monitor sustainability-related risks and opportunities, and whether that process is integrated into the company's overall risk management process. I've seen some questions in the chat asking about the process that should be used, so it's important to say the standards do not set out which process or policy should be used for risk management. That is for the company to determine, and that there are many sort of options for that, but it's not specified in the standard. So let's think about the climate-specific considerations applicable to risk management. So a company is required to disclose information this is broadly consistent with what you'll see in the TCFD, except the ISSB requirements ask for more detailed information about the inputs, the input parameters that the company has used to identify risks, whether and how they have used scenario analysis to inform their risk identification, and whether risk management processes have changed. So on the process side, scenario analysis is generally used to inform your assessment of the business's resilience to climate change. However, it can also be used as a process to inform risk management. And the same applies to opportunities. What process has been used to identify, assess, prioritize and monitor opportunities, and is this integrated into the overall risk management process that you'll use for many different purposes to identify and disclose principal risks to the company? Now, on the climate-specific standard, we have got a definition of climate-related risks, and this is based on the TCFD's recommendations. So there are two types of risk: transition and physical. Transition risks arise from efforts to transition to a lower carbon economy, and they're often categorized as being policy and legal, technological, market and reputational risks. We can see some examples in the middle of the screen. Could be increased pricing of GHG emissions, enhanced reporting obligations, exposure to litigation, the cost of transition to a lower emission technologies, changing customer behavior, uncertainty in market signals, and the increased cost of raw materials. So these are examples of transition risk. With physical risks from climate change, these can be event-driven, which are acute physical risks, or they can come from longer-term shifts in climatic patterns, and these are known as chronic physical risks, the longer-term risks. So we've got a few examples in the middle of the screen there: increased severity of extreme weather events and changing weather patterns, including changes in rainfall and temperature, sea level rise, reduced or changed water availability or quality, biodiversity loss, changes in soil productivity, all examples of physical climate risks. Now, at the far end of the screen, the third column there, we can see that in both cases, these risks can carry financial implications that cause changes to cash flows, access to finance, the cost of capital, and these financial effects can be felt over different time horizons. So you can imagine financial effects perhaps relating to costs resulting from direct damage to assets or indirect effects of supply chain disruption, or even things like customer demands for there to be deployment of new technologies. So we're trying to move now, I think, to slide number 83. I can see that the slides are magically moving in the background here, but we'll get back to, here we are, slide 83, thank you. And this takes us on to the definition of climate-related opportunities in the climate standard. So the types of opportunity you see listed in the first column there can come from resource efficiency, using different and lower emission sources of energy, developing products and services that give you access to new or different markets, and of course enhancing or building the company's resilience to climate-related risk by building on those climate opportunities. And we can see some examples in the middle of the screen, some of which I've just referred to, perhaps enabling you to differentiate yourself against competitors through your product and service offering. And again, as we said before, these opportunities could have positive financial and reputational effects. So on your cash flows, access to finance, cost of capital, and those positive effects could be felt over different time horizons. Now we're going to look at an example. And this is an example from the RS Group's Annual Report 2024. And the RS Group is a UK-based distributor of electrical and industrial equipment, but they have global operations. They operate in 35 countries. They've got over 1 million customers, 9,000 employees, and so on. And what they do is that they provide their customers with maintenance, repair, and operations equipment and machinery. So this is an example where the RS Group have analysed their climate-related risks and opportunities, and in particular, the physical risks impacting their business. So in this excerpt, we see a summary of their physical climate risk assessment. In the first column there, you can see some little icons like a little red wheel and so on. And this tells us what part of the strategy is most affected by the risk. And in this case, the little red wheels mean that the risks are most affecting the business operations. In the second column, we can see a description of the risks, which I won't go into now, but the sorts of things we've already talked about, like increased costs or changes from extreme weather events. So they're showing us the most significant physical climate risks, and mainly they relate to the impact of extreme heat on their distribution centres and the potential for extreme weather events to cause physical damage and disruption to their customer supply operations. In the disclosures, they also provide some helpful information on each risk, including the business owner of each risk. So you can see that in the third column there. And they also tell us the metrics that they're using to monitor the way in which those risks are unfolding. So we see who's managing the risk and what metrics are used to track the risk and how it's proceeding. This also tells us that the company is investing in managing these risks. So we see information in the penultimate and ultimate column about the types of investment that the company is making to manage the risk or capitalize on the opportunity. So this is an example where we also see connections. As I said, we can see the connection to the strategic part of the company's activities and what the company is doing to manage those risks. So with that example done, we're going back to Bella now, who's going to take us actually into the metrics and targets content area.
Thanks so much, Lois. We will now spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standards. Let's start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. For example, what is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? So now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So disclosures include whether they are qualitative or quantitative, and whether it's set voluntarily or by law or regulation. And disclosures also include the metric used to set the target and to monitor progress towards its achievement, the baseline period from which progress is measured, and the period to which the target applies. And disclosures also include what are the milestones and interim targets, if there have been any revisions to the target, together with an explanation about the revisions. Okay. Yeah, so it's time for another example. Over to you, Lois.
Thank you, Bella. And this is an example from a multinational steel manufacturing and mining company called ArcelorMittal. It's from their 2024 annual report. And as you can imagine, steel manufacturing and mining is very difficult to abate GHG emissions. However, the company tells us on the top right-hand panel under the title Climate Change and Decarbonisation that they identify climate change as a top material sustainability issue. They tell us that since 2018, they've reduced their CO2 by about 46%, and they've done this mainly through the footprint and asset optimization of some of their most intensive types of capacity for steelmaking. They tell us that the activities that they use for decarbonisation fall into 4 key areas. So, for example, securing resources for the transition is one of them. And this includes renewables and high quality metallics. And elsewhere in the report, the company tells us that it is investing in some cases in its own renewable energy projects and breakthrough technologies. So we can see what the trend is, that they're reducing their GHG emissions, and we can see how they're doing it because they've got 4 key areas related to decarbonisation. Now let's look at the table at the bottom, and this is Bella's just been explaining to us the requirements on metrics, and this is how this company determines the metrics that they are using to measure and monitor ArcelorMittal's decarbonisation progress. That's at the bottom of that first panel there. So we see that there are adjusted absolute CO2 equivalent footprint metrics. And there are 2 listed at the top there, the top 2 rows, because one relates to scope 1 and 2 worldwide, and the other in Europe. Now, if you follow the columns along, you can see that we have the trend here monitored from 2018 up to 2024. So you can see the percentage reduction in these. In the middle 2 columns, middle 2 rows, I beg your pardon, rows 3 and 4, we see the adjusted CO2 equivalent intensity KPI, one for steel and mining and one for steel. And again, these are broken down between scope 1 and 2, worldwide and Europe. Now, the adjustment relates to structural changes to the portfolio of the company for the previous 12 months. So it just enables there to be comparison so that there's some standardization across the portfolio for comparison purposes. Then finally, we see, if we could go back to number 89, I think. I don't know if you can see this. Ah, here we are. We've got jumping slides. The CO2 equivalent intensity for steel only, and this also includes scope 3 in the final 2 rows. So these are the indicators that the company has decided are those most appropriate to measure and monitor their decarbonisation progress. Now there's some yellow underline right at the top left-hand panel, and it says that reductions are only likely to be made with the successful deployment of steelmaking and energy transformation projects. And you can read elsewhere in the report what the company is doing about that, but also that this should be set within their overall ambition, that is to have a leadership position within the steel industry and achieve net zero steelmaking by 2050. So with that example, I think it's back to you, isn't it, Bella, for climate metrics and targets?
Yeah, thank you so much, Lois. Now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. Yeah, the TCFD framework included recommended disclosures, which IFRS S2 builds on and S2 as part of required disclosures. For example, S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. Additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and the associated joint ventures, and information about the company's financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IFRS S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the ISSB's training tool on this topic. We will share the link in the chat, and you can also find it on the ISSB's website. Likewise, there are some additional disclosures compared to TCFD for targets as well. For example, S2 requires disclosure about how the latest international agreement on climate change has informed the target, and whether the target has been validated by a third party. And the IFRS S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And the S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectorial decarbonization approach. Okay. Questions on GHG emissions often come up in questions on metrics and targets disclosures, so we wanted to address some of this briefly. For those who might not be familiar with the different scopes, as you can see that there are Scope 1, Scope 2, Scope 3, and the Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And finally, Scope 3 is all other indirect emissions that occur in the company's value chain. S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. And the S2 requires a company to disclose whether and how the company is using an internal price on carbon for this decision making, and whether and how executive remuneration is linked to climate change. Okay, so it's time for an example. Over to you, Lois.
Thanks, Bella. And here we have an example about disclosure of GHG emissions and the way in which they're broken down by a company called Enel, which is an Italian producer and distributor of electricity and gas. Now, as you'll appreciate, we can only share excerpts and little extracts from examples in this presentation. So we need to understand that these GHG emissions are presented in the context of a wider ambition. And Enel's GHG inventory is to achieve net zero emissions by 2040, but also to promote the role of electricity as an energy carrier as part of driving the overall transition to net zero globally by 2050. And this company has a decarbonisation roadmap with various targets that have been validated by the Science Based Targets Initiative. So there's a lot of background to the little extract that you see here. But let's have a look at the extract. At the top of the slide, you can see the company's carbon footprint, their absolute greenhouse gas emissions by scope, and also a comparative analysis. So the columns that have the diagonal lines on them relate to 2022, and the dark blue columns relate to 2024. So you can see the trend and the reduction pattern in each of the scopes, scope 1, 2, market-based, location-based, and scope 3. And you can see that the trend is that these emissions are going down. Location-based scope 2 emissions generally reflect the average emissions intensity of the local electricity grid. So it's connected to the electricity you're sort of tied to using on your grid. And the market-based emissions from scope 2 reflect the contracts you enter into for the purchase of electricity. So two different ways of describing scope 2 emissions there. At the bottom of the page, you can see how the scope 1 emissions and the scope 2 emissions are broken down by greenhouse gas emission source. So you can see that they're showing us here how the emissions are broken down from power generation. So it's just one way of breaking down the emissions. And again, you can see the comparison between the 2022 baseline and the 2024 results, location and market based. So let's go on now to a Zoom poll. And the question here is, what is the objective of metrics? And in particular, what's the objective of the ISSB disclosure requirements on metrics? So you can select as many as apply. Is it to understand performance in relation to the entity's sustainability related risks and opportunities? To understand progress against targets? Or to understand the company's assumptions for the future? I'll give you a minute to think about that one. Right, we've got over 52% participation, so let's end the poll there and I'll share the results. And most of you picked A and B, which is correct. That is correct. Now, I'm sure there'll be those of you saying, well, of course, the metrics can help understand the company's assumptions for the future, and that is correct. However, the point of asking you this question is to encourage you to read the ISSB standards themselves, because you'll see, for example, in paragraph 27 of S2, and there's an equivalent in S1, that the standard reads the objective of climate-related financial disclosures on metrics and targets is to enable users of general-purpose financial reports to understand a company's performance in relation to risks and opportunities and progress towards any targets. So this is really to point out to you that at the start of each of the content requirements, there is this description of the objective, and it might help you to craft your disclosures to ensure that they meet the objective of the standard. So well done, you got that right. And I think we're going to move on now to another part, another module. Second part of the Align module, which is called Additional Disclosures. Now, we've talked about the types of disclosures that are required by the ISSB standards, but what happens if you want to make other disclosures? So in addition to what we called earlier, the global baseline, how do you do that? Well, you might want to build on the baseline for various reasons, because there are local or listing requirements that apply to you, might also apply to companies in your supply chains. There might be policy objectives that you want to make disclosures about, because they are policies that are aimed at promoting sustainability, perhaps through subsidies or tax cuts, or they're policies that are designed to discourage certain practices. Thirdly, there might be industry standards that you want to or have to align with, that mean that you can make disclosures that are very specific to your sector and your industry. And finally, you might want to make disclosures in addition to those required by the ISSB, because you want to meet the information needs of other stakeholders, others in addition to investors. So when you're making additional disclosures, of course, you know, the ISSB is very much focused on its own standards, and they are consulting with and working with a number of jurisdictions around the world to ensure that that momentum of adoption continues. Figure we've got here is 20 already committed to using the ISSB standards. I think the figure we had from Elizabeth this morning was 35 have adopted or are taking steps to adopt the ISSB standards, but we've got a link on this slide to the jurisdictional sustainability consultations that's made available on the IFRS website. So please do have a look there if you're interested in learning which jurisdictions are adopting or consulting on adoption of the ISSB standards. In addition to working with jurisdictions, the ISSB works with voluntary and standard-setting organisations, and we've talked about this a bit already, so I won't go into it in detail, but the CDP, formerly the Carbon Disclosure Project, has aligned its climate standard with the IFRS S2. The Greenhouse Gas Protocol is the standard to be used for the calculation of greenhouse gas emissions, and the ISSB is actively engaged with the GHG Protocol team on their governance and other arrangements to update the protocol, so they're working closely together. We've talked about the fact that the ISSB and GRI are seeking to deliver full interoperability to align their common disclosures wherever possible and to support a seamless sustainability reporting system. We've heard that the Transition Plan Task Force disclosure-specific materials are already within the IFRS Foundation under their responsibility. And I can see many of you have asked about the Task Force on Nature-related Financial Disclosures, and the ISSB is considering how to build upon the recommendations of the TNFD. I think Robert's answered a question about that in the Q&A, if you want to go back to the Q&A and have a look at that if you're interested in TNFD. So I think the next slide is about GRI, and I just want to draw your attention here to the fact that on the GHG emissions standards issued by the GRI and the ISSB, a study has been done that shows the extent to which they are interoperable, and they are really quite aligned, the two types of standards on GHG emissions. And as I said before, the two organisations are collaborating to deliver full interoperability, for example, on the GRI's biodiversity standard that is being used to support the ISSB's ongoing project about biodiversity, ecosystems and ecosystem services. And the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. Now, when we asked you earlier what standards you are using for reporting, quite a number of you wrote in the chat that you're using the European Sustainability Reporting Standards that are required to be used for those that are within scope of the Corporate Reporting Sustainability Directive. So just to let you know that the ISSB also works with the European standard setter closely. They've already looked at the extent to which European standards, which are themselves under review, as many of you know, for simplification purposes through the so-called omnibus process. But what we see so far is a high degree of alignment between the climate disclosure requirements of the ISSB standards and ESRS. And the two organisations are working closely together to reduce complexity and duplication as far as possible. You'll see that there are some differences which are listed on the screen here. So the ISSB has a few additional requirements, for example, on financed emissions, although I think that might also be under review. And ESRS, they have additional requirements for stakeholders that are interested in impacts of different environmental and social effects. So there are some differences, but there's also a commitment to and a degree of alignment. Let's look now at integrated reporting. I think some of you said you were using this, and again we see a report on the left-hand side which explains how you can get started with using the integrated reporting framework as a complementary tool to support your IFRS S1 and S2 disclosures. The integrated reporting framework, it gives support on a more holistic view of the value creation process and a more complete picture of how value is created over time. And it's also intended to meet investor information needs. So you'll find lots of different types of observations in this report, including dedicated FAQs and a mapping tool about how you can use integrated reporting. But I suppose one of the most important things that those of you that know integrated reporting will probably pick up on is that integrated reporting is underpinned by integrated thinking. And the integrated thinking, of course, is a very important input to your preparation for disclosure. So do have a look at that report if you're interested in integrated reporting. Let's have another Zoom poll now, which is, and this one asks, you can only choose one of these, by the way, only one answer. Your disclosure objectives should consider the ISSB standards only, or the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance. I'll give you a minute to think about this, but you're responding very fast and I can see a clear pattern emerging that you know the answer. Yes, over 50% of you have participated and there's a clear pattern, so I'm going to share the results. Of course, it's the last answer. When you're thinking about what to disclose and why and how, you can refer to the ISSB standards. Of course, you must refer to regulatory requirements. And if ISSB standards have been adopted in your country, of course, you must refer to those. But you can use other sources of guidance, and we've referred to those other sources already in this presentation. So yes, all of you responding in chat, yes, D, you've got it right. So well done. Correct answer. And I'm handing back to Fiona now for the Module 2 summary.
Brilliant. Thank you, Lois. And you'll be pleased to know we're at the end of our largest module here. So we're well more than halfway through the session, don't worry. But Module 2, there's lots to talk about. So that's that one wrapped up. So we're just going to take a minute now to remind ourselves of what we've learned. So we reviewed all 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these do not operate in silos. We saw in our examples that despite having 4 separate categories of disclosure, they're all interconnected. And we also discussed how your disclosure might go beyond the requirements of S1 and S2. For example, to meet the needs of different stakeholders or to meet regulatory requirements in certain jurisdictions. And what's important to remember when doing this is that the ISSB standards have been purposely developed to act as a baseline. And the building blocks approach allows report preparers to add additional disclosures on top. So in doing so, you do, however, need to be careful not to obscure the requirements of S1 and S2 if you are going to add more on top of that. Okay, so bringing that module to an end, we're going to do another quick exercise. And so here we just want to take a moment to reflect on what your key gaps are that you need to address in your current disclosures or internal processes. So for this exercise, we encourage you in your own time to do a more full gap analysis, but we hope we can just start with reflecting on a few key points here. So this is where you're going to want to think about what your next actions might be. So thinking about what your gaps are, what the enhancements are to your own reporting that you already do, that you might want to continue to develop, knowing what is required now under S1 and S2. And also, are there ultimately any new topics or any new processes or perhaps internal skill sets and resources that you might need to help you meet those objectives you set for your disclosure plan? So the question we set you in Menti is just a broad question of what are the key gaps that you need to address in your current disclosures or internal processes. So take a moment to have a think for you, what you think that gap might be. Of course, you might have more than one, but maybe just share what you think the key gap is that's most front of mind for you. And I'll take us back into Menti so we can see those responses. And a quick reminder, the link has been shared a few times in the chat now, but you can also go directly to menti.com and enter that code that you see at the top of the screen as well if you haven't been able to join us there yet. But I'll just give everyone a minute or two to put some responses in, although I see some of you have already been quite quick and got there already, which is fantastic. So let's see, what kind of things are we getting so far? So we see some people mentioning their data gaps in particular, so maybe having good data. Absolutely, I think for many organizations that is a new area or just an area where we're now having to push into much more detail than we might perhaps have done in our original reporting. So definitely thinking about what the data is that you need. Maybe some of it will exist somewhere in the business already, at a site level operationally, but perhaps you don't currently have a process to aggregate that information to a corporate level. So thinking about how you can tap into what's already happening at your sites. And maybe whether you need to think a bit more about collection processes and systems now as well, if you're going to be asking your business units to get you more information than perhaps you did in the past. So here I also see someone's mentioned a shortage of team and underestimating the efforts and the impact by the management. Definitely, I think often we might have managed in the past with quite a small amount of resource on sustainability. And now obviously we're seeing as these standards develop, as the expectations grow from investors and regulators, more resources ultimately needed. So, quite a key thing here is going to be making that argument with your leadership team to make it clear that this needs to be resourced. I mean, I think one thing that we always say is if you look at the resource in your organization for financial reporting and accounting, perhaps you have a whole department or a team focused on that, whereas sometimes we expect maybe one or two individuals to manage all sustainability reporting. So whilst you may never get to having an entire department on reporting, you do need to think about upping the resource levels potentially by quite a bit compared to what you were used to. But of course, this is regulatory requirements, and it's something that your investors and stakeholders really want to see. So that is a key argument. I also see some people mentioning governance structures and risk management, of course, a very common area as well. And I think here, this is where we really recommend, and we've talked to this point, making sure that you're using those existing governance and structures that you already have. So you might take the approach of setting up a dedicated committee, but actually, if you have a well-evolved governance structure, maybe it would make more sense to integrate sustainability into those existing bodies. So, for example, your risk committee or audit committee, particularly on the reporting side. And similarly with your risk processes, engaging closely with the professionals in your risk team to think about how you can build this into any existing enterprise risk assessment processes. So wherever you can, using those processes to assess and manage sustainability risks as well. Okay, no, thank you everyone for taking the time to reflect here. It's really good to see. I think we see a lot of common themes here around the data, around maybe risk processes. And I see mention of a few similar things. Also, some people have mentioned the supply chain, and I saw value chain coming up earlier as well. Of course, absolutely. Like, it's one thing thinking about how to collect this in your own organization, but if you start to reach out to suppliers as well, that of course can be very challenging. So, I think engaging early with your suppliers on these expectations, building them into qualification processes if you can, or routine data collection processes that you might have already is helpful. But of course, there will be some efforts potentially to take your key suppliers on the journey with you and help them to understand why this is important to you. But I think that's another area where we'd really focus on prioritizing your biggest suppliers to start with and getting some initial information, or perhaps you can use proxies and estimates to begin with and then work towards getting actual data from suppliers over time. Okay, I think we see lots of quite common answers here. I'll just see if there's anything new coming up. Maybe some people mentioning that climate disclosure might be a particular area. And of course, with having the dedicated S2 standard, that's one topic that you can really get moving with. But, there's a lot to cover there. So, of course, understandable that that might be something that you think will be difficult or needs more effort. Great. So I think, those have highlighted a lot of really good points. So we'd encourage you to take some of those key gaps away, start to build out a little bit more of a checklist about how you can address that. And we'll share some resources later in the session that can help you with that further as well. And a few of the things that probably we just highlight are important to think about at this stage would be starting to think about how you're going to integrate this information into your annual report as well, which, as we've heard, is the location that reporting is asked for under the ISSB standards. So whereas perhaps maybe you had a standalone report before, now it's really thinking, how can you connect and integrate into your annual report? So we'll talk a bit more about that under the communicate module. And indeed, the connection point, I think, applies as well between your sustainability disclosures and your financial disclosures increasingly. So we've talked, of course, about the importance of starting to try and quantify financial effects. And here it's going to be really important, to connect with your colleagues in the finance team, or maybe you're a finance professional here as well, which is great if so, because that rigor and control that we have around financial reporting is increasingly going to be needed for sustainability as well. Okay, thanks everyone for sharing those ideas. That's really great to see. So I will now take us back to the slides. I'm going to hand back over to Lois, who will be starting us on the implement section.
Thank you, Fiona. I've just been checking out the Q&A box and I see that we're at about 120 something questions. So we really appreciate your questions and we like answering them. But what I noticed was lots of the questions are about how. How do I do this? So we're going to look at that in module 3. We're going to look at processes and practices that help us with disclosure and how to respond to the ISSB requirements. So we've got 3 parts to this unit on how to identify sustainability related risks and opportunities, evaluation processes you might use, and whether and how to integrate your sustainability processes with your existing systems and practices, or whether to have separate ones. So let's look first at how to identify sustainability related risks and opportunities. So IFRS S1, I think it's paragraph 3. Paragraph 3 asks companies to disclose information about all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. And IFRS S2 says similar about climate related risks and opportunities. But what happens if there are risks and opportunities that affect your prospects, so they fall into this category of all sustainability related risks and opportunities, but there isn't currently an ISSB standard that can help you? Well, let's start at the beginning. Which risks and opportunities should you consider making disclosures about? Well, the ISSB standards require you to consider the SASB standards when you're seeking to identify relevant risks and opportunities. And those SASB standards are available on the IFRS website, and they set out disclosure topics, metrics, and targets that apply to different sectors. So they might help you to consider which risks and opportunities are most likely to affect your prospects within your sector. However, when identifying risks and opportunities, you can also consider IFRS educational material on sustainability related risks and opportunities and the disclosure of material information, and that specific guidance is available on the ISSB website. You can look at the Climate Disclosure Standards Board Framework Application Guidance, also available by link from the ISSB website. You might consider a practice that applies to your own industry, maybe that's been set by an industry group that you belong to, or the materials of other investor-focused standard setters, and the integrated reporting framework would fall within that category. So you've got all these different resources that you can use to identify risks and opportunities. So having done that, what information should you disclose? Well, again, the standard requires you to consider SASB standards for this purpose. So are there disclosure topics, metrics, and targets that are appropriate for disclosure about the risks and opportunities that you've identified? The types of other information you can look at is, as we've described before, but you can also refer to GRI standards and European sustainability reporting standards these are other sources you consider if they cover topics in which you're interested because you know they represent a risk or opportunity to your organization. So let's have a look at a real-life example of identifying risks within an organization. This example comes from Philippines-based Ayala Corporation. Ayala is a big conglomerate company that has many different types of business, including property development, banks, healthcare, and technology. So lots of different activities in this organization. This example provides an overview of the company's risk assessment process. And you'll see that the first box there, communication and consultation, applies across all of the 4 boxes that you see on the screen. And that's because the company is very keen to learn from what they've already done in the past and to communicate and consult widely across people within their own organization, business units, but also other stakeholders. So this is a kind of connecting theme for their risk process within their organization. Box 1 then we see is that the company starts by establishing the context within which they operate and that tells them about the internal and external factors that might affect their risk landscape. So these could be things internally like their organizational culture, values, strategic objectives, sustainability targets, but also external factors are taken into account when establishing the context, and these are things like sustainability, megatrends, natural hazards, climate change, a broad range of political, financial, legal, economic, social, and environmental factors. Beyond that starting point, the company then does their risk assessment, identification and analysis process. And what we can see in each box is the output from each of these process steps. So in the case of the risk assessment, the output will be understanding the risk universe, the dictionary that they use to describe risks, and a portfolio and analysis report. And they also tell us who's in charge of each of these steps. The third step is risk treatment. So what's the appropriate plan of action to address the risks in functional areas? The risk treatment plan. They tell us again who's in charge of the risk treatment. And finally, monitoring and review. So the diagram shows all of these different steps, and in the report itself we can see the risks displayed on a heat map. They show the relative impact and likelihood of effect on the business, and there's an explicit connection between this process and the ESG material topics that the company has identified elsewhere in the report. Let's have a look at one more example. Now, this is an example from a company called Nest. It's a company based in Finland that produces sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. And this extract comes from the climate section of the company's annual report. It shows how the company identifies both risks and opportunities in different temperature scenarios. So we've got the net zero world at the top there, and they describe what the net zero world looks like. So we get rapid and radical emissions reductions, for example. The company then describes the opportunities they see under this scenario. So the accelerated demand for renewable and circular solutions is going to be good for them, considering that they are a producer of, for example, sustainable aviation fuel. And they tell us the risks as well, that the risk is that they need to make sure they can get the raw materials, for example. And interestingly, at the end of that net zero world scenario, they tell us the indicative financial impact to Nest under this scenario is positive. And maybe you would expect that because this is a company that deals in sustainable solutions for the chemical industry. Now, in the interests of time, I won't go into the other 2 scenarios, compromised climate targets and net zero EU and North America 2050, but the same pattern is followed. What's the scenario? What are the opportunities? What are the risks? And what is the indicative financial impact? So under the compromised climate targets, where there's failure to take quick climate action, the financial impact indicatively to the company is slightly negative. And maybe you would expect that from a company that's whose objectives are to produce sustainability solutions. So we've already talked about this, so I won't go into it in detail, but we've already said that because it can be quite difficult to assess, identify, report on risks and opportunities, there are these so-called proportionality mechanisms that allow a company to use all reasonable and supportable information available to it without undue cost or effort. So what does this mean in this context? It means that reasonable and supportable information is specific to the company. So things that you know about. So you can look at global megatrends, yes, but also need to translate those into the known risks that are specific to your company. It also, reasonable and supportable information takes account of the external environment, as we saw in the Ayala example. It includes information about past events and current conditions that the company already knows about, but also forecasts. And we saw that in the Nest example, where they use scenarios, not so much to forecast, I wouldn't say technically, but to sort of think about what the future might be. And in some cases, the standard itself will specify what constitutes reasonable and supportable information. So the next part of our implement module coming up from Fiona now.
Brilliant. Thank you, Lois. So once risks and opportunities are identified, companies are going to need to evaluate the financial effect of those risks and opportunities. And this can, of course, often be most daunting when first starting. So here we're going to briefly review a few key concepts that can help in this process. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. And it also asks for the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So, for example, you might test your company's resilience against new regulation to limit certain high emissions activities, or your company's ability to respond to changing crop yields. If, for example, there are more frequent heat waves that impact those. So to do this, you're going to need to use climate scenarios, and you're going to need to analyse what effects may occur under these different scenarios. So it's important to remember when considering scenario analysis that it's not asking you to predict or project the future. There's no likelihood ascribed to these scenarios, and no one's going to hold you to what you're saying here in terms of the likelihood of it happening. It's really a tool to test your resilience against potential future events. So plausible, possible futures, but not a prediction or a forecast. So S2 doesn't specify which scenarios a company should use, because ultimately that's going to be dependent on your industry sector, the types of risk you want to assess, your location, etc. However, it does ask you that you should use scenarios and provide information about which you've selected, and that you should provide information about the assumptions that you've made in your scenario analysis. S2 also includes guidance on how a company can determine its approach to scenario analysis. And this can encompass a range of practices, perhaps starting with qualitative scenario narratives and moving to perhaps more quantitative statistical methods over time. So overall, companies are asked to use an approach that's commensurate with their circumstances and that uses all reasonable and supportable information available to them without undue cost or effort. So we'll have a look at a quick example here. I know it's a topic where really we could talk all day and go into a lot more detail. Unfortunately for this course, we don't have time to go in lots of detail, but we'll share some resources with you at the end of the session in terms of knowledge hubs where you can go for lots more detail. But the example we're using here is Nestle. You're probably familiar with the company. They're a Swiss multinational food and drinks company. And this is just one output from their climate scenario analysis that we see on the screen here. And it shows the potential impact of physical climate changes on the yields of 12 of their key agricultural commodities. And this is looking out to 2040 under a medium emissions scenario. And so this shows that some areas are going to see quite significant changes potentially in crop yields as a result of changing climate. And this also, in their report, they'd go on to talk about how actually that change in yield could affect the quality of their raw materials. It could potentially lead to price volatility and increased input costs for them. And so they go on to summarize some of the outcomes from this analysis and some of the different activities that they're planning to take in their business to improve their resilience as a result of this analysis. And so I think it's a helpful example of showing not just how you can do this analysis, but how you can actually then take action to improve resilience as a result of it as well. So as I said, just one visual to summarize the key message, but we'd recommend reading their report there to find out more about how they did this. And so, of course, when we're anticipating the materiality of future events, that can be very challenging. And so to help with this determination, IFRS S1 asks you to consider a number of issues to help with your determination. So you could think of the list here as identifying all of the steps and information you need to come to your judgment. For example, companies should be considering low probability but high impact events. They should be looking at their uncertainties relating to future cash flows as well. And so what's important here is to continue to assess and provide transparency on these uncertainties. It's fully understood that they will exist, but it's important each reporting period to continue to evaluate those and be transparent with your stakeholders about them. Okay, and back over to you again, Lois, for the next segment.
Thanks, Fiona. And I was glad to see in the Nestle example that in most jurisdictions, coffee yield is unlikely to be adversely affected. So good news from the scenario planning there. So we're moving on to the third element of our implement project, which is about whether and to what extent new processes need to be developed to support your disclosure on whether you can integrate sustainability considerations into your existing processes. Now, the good news is, for many companies, it's unlikely you're going to have to start from scratch. But when considering whether you need to create something new or adjust existing processes or maybe use them as they are, the types of things management might need to consider are doing a gap analysis to check whether existing systems and processes are suitable and for climate sustainability disclosures, and whether they're suitable, as I've said. What prioritization criteria are used in your existing processes? As you know, sustainability risks, opportunities, and impacts have different characteristics to other types of risks and opportunities. So you might need to consider new prioritization criteria beyond your current ones to include things like likelihood, impact, vulnerability, and speed of onset. The company might want to evaluate its existing initial controls framework to see whether it's suitable for sustainability disclosure, which contributors, departments, and individuals and experts are needed to contribute to sustainability disclosure, how different internal and external factors are interconnected. We saw that in an example earlier. Which uncertainties relate to sustainability-related risks and opportunities, and how the company will evaluate and deal with those uncertainties. And finally, what resources are in place or are needed to develop existing systems or create new ones. So in this case, you might need to go through a change management or budget request system within your organization if you think that some new processes are going to be required. Now, as you know, as part of your homework, or as your homework, we've suggested that the company develops a disclosure plan. Now, a disclosure plan can be a standalone disclosure strategy, or it can be part of a wider disclosure strategy that takes account of other things that you need to report in the public domain. Now, a disclosure plan can help a company to take control of its narrative. Seen a question in the Q&A about this. We don't want this type of disclosure to become a tick box exercise. Your company is being asked about its strategy, its risks, its processes, etc. And the disclosure plan really helps you focus on that and take control of your own narrative, not just respond as a compliance tick box exercise. A disclosure plan also supports internal collaboration so that you can have effective knowledge sharing and cross-functional teamwork across different staff members and departments. So who needs to be involved? Maybe risk management, company secretarial, procurement, finance, HR, energy, who knows? But this actually having a plan and noting who's involved will help you. And finally, and I think most importantly, a disclosure plan acts as a reference point and an audit trail where you can record where and how judgments have been made about your disclosure practice. So you can write down things, for example, about how data will be sourced, what systems and controls are going to be used, whether and from whom you will gain assurance, and what are the sign-off procedures. All of these things, very useful to make a permanent record of. Let's have a look at an example here. It's a bit busy, so I'll just tell you roughly what we're seeing here. It's an example about how a company called Novo Nordisk, which is a Danish pharmaceutical company, tells the readers of its report how it has prepared the report. So it provides details here to users of reports about which reporting standards and regulations have been used to prepare the report. Where it's a regulatory requirement, of course, the report has to be in accordance with that. They tell us that some disclosures have been prepared taking other sustainability reporting standards and guidelines into account, and they list them there: the GHG Protocol, the Science-Based Targets Initiative, the TCFD, and so on and so forth. They tell us the approach and scope used for data collection in this example, the verification processes that have been used, how and where estimations apply, and there's other contextual information here to help readers of the report understand how their reporting has been done. And I can't stress enough how helpful it is to make all these decisions before you get to the start of the reporting year. So let's go to a Zoom poll now, and you can only answer one, yes or no. And the question is a disclosure plan required by the IFRS sustainability disclosure standards? You can say yes, you must disclose your plan, a bit like we saw from Novo Nordisk, or no, but it's a very helpful tool. Give you a moment to think about that. Lots of thinking going on here, a slightly slower response rate. Right, we've got over 50% now, so in the interests of time, I'm going to end the poll, share the results. 56% of you said no, but it's a very helpful tool, and 56% of you are absolutely correct. There is nothing in the ISSB standards that says you are required to have a disclosure plan and you are required to disclose details of it. There are some requirements where you are asked to set out the methodology that you've used or the process you've used, yes, but there's not a requirement to have an overall disclosure plan. We're just recommending it for your homework because we think it helps companies, but it's a voluntary exercise, of course. So well done. We do this exercise with lots of audiences and people often get it wrong, but this audience got it right, so well done. Let's go to another Zoom poll now. And the next Zoom question asks up this: a disclosure plan can help a company can select all that apply, take control of its narrative within general purpose financial reports, support collaboration, act as a reference point and audit trail for disclosure, or as a reason to skip full disclosure as prescribed by the ISSB. What do we think? I can't see the Zoom poll appearing, but hopefully our lovely participants can.
Hi, Lois. Sorry about that. Would you like me to read out the results, perhaps?
Yes, please. Thank you. If it's you next, I'll hand over to you.
Thank you, Lois. Sorry, I'm not sure why that's the case, but I'll just give everyone another minute. I see close to 50% of you have taken part. And I think in the interest of time, we will close the poll there and I'll just share the results with you. So I see that the most common answer there is option 2, but most people there have got that right, that the first 3 options are indeed correct. The only one indeed that is not a correct answer is option D, to skip disclosure. So lots of good reasons how a disclosure plan can help you there. As we said, it's optional, but we really recommend it, and that's something your homework exercise supports you on as well. Okay, so it is back to me now, so I'll carry on. And this brings us on to summary of our 3rd module. So well done. We're doing well to get through the content, and we really appreciate all of your concentration and engagement. So just wrapping up on a few key points from this module. So firstly, let's come back to those connections. And in the last module there, we highlighted the importance of connections between the 4 core content areas of disclosure. And then here we learned that many of these connections as well exist between a company and its external and internal environment. And these connections are what we need to focus on when we're identifying key risks and opportunities. And the second thing we discussed in this module was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. And finally, as we've seen, even if some of this data isn't data that you're already disclosing, you might already be collecting it internally for other reasons. Or perhaps you have processes in place already that can help you to collect it if it isn't there already. So try not to start from scratch, try to make use of what you already have wherever possible is really recommended. Okay, so we'll just take a quick step and look into Menti together now to look at this exercise. And our final question for you is just to get a bit of reflection again on this point around implementation and what your existing systems and data collection processes might be that you could already start to use internally to help you here. So I think most of you should be in Menti already, but I see Lois has reshared the link. So thank you, Lois. And let's just take a quick look together at the responses. Okay, lots of good answers coming through already. So, yeah, I see maybe about integrating data into ERP systems. Yes, exactly. You know, I think increasingly as we're moving towards needing that rigor around this information, using those processes that work well for financial and other forms of reporting is very helpful. Yes, I see an answer there. Let's just scroll along a little bit. So using CRM systems as mentioned as well, or vendor management tools, employee feedback channels to collect and track metrics and ensure streamlined integration, all very good things. And then I see utility bills in the management system. Yes, definitely. If you're looking at energy performance and your carbon emissions, energy bills can be very helpful to collect for that purpose, help you to understand your energy costs and how you can save money as well. So we have supplier integrating questions into supplier questionnaires or audits and supplier onboarding. Indeed, as we're looking at that value chain information we talked about, that's a very good way to go about it. I also see HSE reports or environmental monitoring tools, perhaps on emissions. So loads of really good suggestions here. Someone's mentioned maintenance logs too as well. So perhaps looking at the logs of your operational equipment and processes, industrial systems. Okay, great. Banking systems, maybe if you're a financial institution, exactly. Project level due diligence, exactly. So loads of great resources there I think you've already identified that will help you in this space. Of course, the challenge is often just knowing what you have internally and how to start to aggregate it. So I think really we'd highlight the enterprise risk management process has been a key one to tap into here. And also thinking about data management tools. So we're going to talk a little bit now in the next section with Robert around digital tagging and reporting processes in that regard. So that can be something that can really help you on there. And of course, we'd recommend here that also you should be thinking about governance around this information. So particularly now, you need to have this information at a high quality, assurable standard. Setting up the right governance and controls for data collection at the start is important too. Okay, thanks again, everyone, for sharing. So now going to be handing over to Robert for his segment on the final module.
Great. Thank you very much, Fiona. Indeed, we're now moving to the last module of this training. So now we'll be focusing on the communication and with investors, what, where, and how, and we're now This section has this module has three sections. We'll be talking about location and the timing of the disclosures. We're talking about efficiency and confidence. And then to get us started, we'll start with the location and where the disclosure should appear. Before we dive into the specific requirements, we're gonna zoom out a little bit and let's think about sustainability disclosures in the context of the complete reporting package that is useful to investors. And this in this dual purpose reporting model here, where IFRS and ISSB standards address investor needs on the left hand side, while GRI standards expand on sustainability metrics relevant to broader societal concerns. And so together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, allowing both investors' priorities and broader societal expectations. Investors already have access to companies' financial statements, and ISSB standards are designed to identify sustainability-related risks and opportunities that complement financial statements. And this come together in a reporting package that we call the General Purpose Financial Report. As I mentioned, ISSB and GRI share some content requirements. For example, what to report by the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of the IFRS Foundation to bring transparency, accountability, and efficiency to capital markets around the world. So both organizations, they take different approaches to defining materiality, but they are not competing. The GRI approach is set out to understand, set out and understood among sustainability practitioners, whereas IFRS approach is familiar to accountants and relies heavily on management judgment. So together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and societal expectations. So a simple example where how they can interfere is, for example, where a double materiality assessment identified under GRI, for example, that some of those companies' impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors under the IFRS standards. So in the next section, we will then revisit again the material information. I think we should now have a good understanding what material information constitutes in the perspective of the IFRS standards. So materiality has different definitions for different reporting standards and audiences. And in identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified those risks and opportunities, it can determine what information to provide. And this is where materiality definition comes into play. So the definition of material information under S1 is based and aligned with the definition found in the accounting standards. So it means that information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investors' decisions. In other words, the ISSB standards seek to identify and disclose key information that matters to investors. So an entity determines what constitutes a sustainability-related risk and opportunity based on its facts and circumstances. Entities often have well-established processes for identifying, assessing, and responding to sustainability-related risks and opportunities as a part of the management of the businesses. Right, and then we will have a first Zoom poll and then a question. So what information should be disclosed in the annual reporting when applying ISSB standards? So A, B, or C. So please select all that apply. So if omitting the information could reasonably be expected to influence investor decisions, it could reasonably be expected to affect companies' cash flows, it exemplifies the values of the leadership team. So which of these will constitute the information which should be disclosed? A, B, or C? And we're getting our result coming in. With almost 40% of the participants answered this question. And then for those who answered A and B, these are the correct answers. So these are the factors which exemplifies the relevant information. It's not about the values of the leadership team. So the answer C is incorrect. All right, and now we're moving to the next section about the disclosing where to report the ISSB disclosures. So disclosures under ISSB standards has to accompany the financial statements and be part of the same purpose financial reporting package. But as one does not say where in that reporting package the information shall be provided, this is designed to allow jurisdiction-specific requirements on the location of the reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements, and sustainability disclosure must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and be authorized by the same body or individual authorizing the financial statements. And then we will then move to the example and how that could be done in practice. And we have the example of the company Ayala, and then Lois will present it to you. Over to you, Lois.
Thanks, Robert. Yes, we've seen Ayala before. It's our Philippines-based conglomerate, and this is an example from their 2024 integrated report. Now, as an integrated reporting company, they use the capitals model of the integrated framework to show us in this example of the structure of their report, the capitals that act as inputs to their business. In the middle, we see the value creation model that tells us how they create value using their strategy, their vision, business activities, and at the end, the final column, we see the value generated. So it's based on what the integrated reporting framework used to call its octopus diagram, showing inputs and outputs. So in this example, which is used as a kind of a navigation tool, if you like, for Ayala's report, we can see it's quite small, but you can see that in the circles in the middle, you can see that the outlook is on page 42. The material topics are on page 80, I think it says. Stakeholders, page 64, strategy, page 44. So this is a way of using the value creation model as a way of helping companies to navigate both the content of the report, the strategic vision of the report, and also where readers can find the information. Of course, this is not the only way that we report. This is obviously from a kind of a PDF, but Robert's now going to tell us about the evolution towards digital reporting.
Yes, indeed. Thank you. Thank you, Lois. Now, yeah, we'll be talking now about the role of technology and how that impacts the sustainability disclosures. So yes, technology is an emerging consideration, and then increasingly corporate reporting is moving from PDF reports towards information on the web page with structured data sets such as those databases offered by stock exchanges, for example. And the IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce a new requirement. Digital taxonomy provides the common elements or tags needed to make your sustainability disclosure machine readable. This makes it easier to take large data sets like information from the entire industry and bring them all together to analyze them. And digital reporting has a number of benefits. It makes reported information easier to use for analysis. Data is structured in the same way across businesses in a machine readable format. Tagging information potentially allows for automated checks for quality and consistency. And more data collection and management systems are compatible with digital reporting and taxonomies, improving processing and reporting preparation. Tax can have labels and description in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. All right, and I'll be then moving to the next section of this module about communication, and following the discussion on the location and timing, we'll be talking about the efficiency. We added this to the training because a common comment we find from companies is that there is a growing reporting burden, and we hope that to highlight is that when done correctly, efficiencies can be made to reduce the burden. So, first of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information together, then everyone will be satisfied, but that will be against the core concept, in particular for presentation. So it could be helpful to ask the questions, is the information clear and concise? And by clear, we mean it might depend on the nature of the information. For example, whether it could be clear to present information on tables, graphs, diagrams with associated text. And what I mean concise, then concise disclosures need to avoid a boilerplate information, unnecessary duplication of information, and to use clear language. Then let's talk about the quality of information disclosed. Some preparers watching today might be thinking to themselves that they still don't see what the fuss is all about. Perhaps their experience focuses on standalone sustainability reports, or they didn't have much interaction with external audit. And to the accountants watching, I'll say to be kind to your colleagues, have them understand the difference in rigor that it's required in data collection, oversight, sign-off, etc. for the financial statements. So that means disclosures include comparative information are to be restated when necessary. Disclosures should avoid unnecessary duplication and should cross-reference if required. Information has to be material, be connected, and aggregated or disaggregated appropriately. And I mentioned cross-referencing, so let's stay here a little bit and explain what it means. So you may have already noticed that it may appear that there's some overlap in disclosure topics. So for example, you might have the same governance approach for all sustainability issues. And rather than duplicate certain information, you can use a cross-referencing to enhance the efficiency of your disclosure. Cross-referencing to other reports is permitted as long as the other report is available on the same terms and the same time as the sustainability disclosures. The cross-reference information is assumed to become the part of the reporting package. Cross-referencing shall be applied consistently and transparently, and it shall not result in the information becoming more difficult to understand. And more on that topic and the cross-referencing, again, in the real world, we have an example for that. And over to you, Lois.
Thanks very much, Robert. This is an example again from ArcelorMittal from their sustainability report. And what they're cross-referencing here is the core content elements and concepts of the IFRS S1 standards. So you can see them listed down the left-hand side. For example, organizational overview, external environment, governance, business model, etc. But on the right-hand side, under our response, you can see where they're giving you the response. So for governance, they're referring us to the governance and risk management part of the 2024 sustainability report. In other cases, like under risks and opportunities and strategy and resource allocation, we've got cross references to other reports, including the 20F, which is a US required form for companies that fall within the US jurisdiction. So again, you can see here that what they've done is they've said, we are responding to the ISSB requirements and we're telling you where you can find our disclosures that relate to each of those content elements. Back to you, Robert.
Great. Thank you, Lois. We'll move to some mechanism that support adoption. So at IFRS Foundation, we've sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. So one simple thing put in place was to adopt well-known terminology and concepts familiar to preparers borrowing from the accounting standards. Many requirements also in S1 and S2 are to be applied proportionately, recognizing companies will have a range of capabilities and preparedness on these issues. For example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting end without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. And there's a numbers of reliefs in the first year have been introduced, and these include companies being able to limit disclosures to climate only in year 1 and begin reporting on other sustainability related risk and opportunities in the following year. Companies are also able to provide annual sustainability related financial disclosures with their next half-year reporting rather than in the same time as the financial statements. And companies not needing to provide disclosure about scope 3 emissions applying the greenhouse gas protocol corporate standard to measure emissions if they are already using a different measurement approach, or provide the comparative information in the first year of reporting using S1 and S2. Another relief, companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. So we already also mentioned a number of other sources of guidance and guidance and resources, including ISSB standards, CDSB framework, application guidance, among many others. We'll then have another 2 samples. So then, and a question here is, information disclosed in accordance with the ISSB standards should be, and then please select all the answers which apply. And we have 4 options, being A, decision useful, B, material, C, misleading, and D, comparable. And the poll is already open, so I'm seeing answers coming in, and that seems to be fairly easy for you. And then we have almost 50 participants, 50% of the participants answered this question. And yeah, for those who answered A, B, and D, you're right. Of course, the information should not be misleading, so answer C is incorrect. In the next question, we will have the information, is decision useful if it is? And then we have these following options. A, relevant and faithfully represent what it purports to represent. Is B, comparable, verifiable, timely, and understandable. So these are different characteristics of the information, of the useful information. And then please select all the answers which are applicable here. And it's looking indeed good here as well. So I'm going to end the poll, and all the answers here are correct. So all these characteristics of the information are the characteristics of the useful information in accordance to the IFRS standards. So well done to you. Well, and then we're moving to the last section of this module, and we will be then talking about the confidence and how to maximize confidence in disclosed information. So here it's important that trust is an essential component of the sustainability related disclosures, and increasingly so with growing concern over greenwashing. So we will look at the comparative information. An important trust builder is showing data and trends over time, and this is why standards ask for comparatives, and comparative information provides context and helps to indicate progress and underpin strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time. So or the company might change its method for estimating metrics. So in this situation, it's important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant periods from the previous period. Also, it may happen that a company might disclose, might contain material errors. And in this situation, the company is required to restate these errors in the comparatives provided. So revisions or restatements are necessarily only when there is a risk that the material information being omitted, misstated, obscured as a result of this, of not revisiting or restating the comparatives. So information can be qualitative in this case or quantitative. So companies also, what's important to mention here is, and companies sometimes express concern with sharing information that they deem to be sensitive, or that it should, or if shared, it could deplete their competitive advantage. So in this case, the ISSB standards relieve a company from disclosing information about sustainability related opportunity if that information is commercially sensitive. So if this is something you are concerned, there's a further detail, it can be read out in the handout. All right, and moving to the almost very last topic here, it's a statement of compliance. So finally, it's important to build confidence by providing clear statement of compliance. So the company that complies with all the requirements of the standards, even the reliefs, is required to make an explicit statement of compliance. There's also additional guidance published by the IFRS standards, a guide for preparers, which can guide you in that respect. In this very last slide from this training, I want to then bring this list of the things to remember. You can find in the handout slide deck an additional slide in this section with reminders or how to report effectively, and I do highly recommend reviewing that. Okay, now I'll hand over to Fiona for the summary of the module 4. Over to you, Fiona. Thank you.
Brilliant. Thank you so much, Robert, for that. And as Robert says, this brings us to the end of our final module. So there's just a few points to cover now from my side. So thank you for staying with us for so long already. But if you bear with us, we'll cover off a bit of a wrap-up exercise, and then we'll talk through some closing points with some key resources for you to take away, and also some information about your training certificate. So don't go away, lots more to talk about, but we're nearly there. So just to wrap up this final module and talk about what we covered here. So firstly, we discussed where to report information. And what was important here was the audience, or who you're reporting to. So making sure to be clear from the start who the primary user of information is, and that will help to ensure that this information is the right information for their needs. And of course, as we've spoken about here for the IFRS S1 and S2 standards, the primary user and audience is investors. Then we discussed efficiency, and I think a key takeaway here is that less is more. So the objective isn't to overload investors with information, and indeed that could actually be harmful given it can obscure the information that is required. So using the standards as you get started can be a good guide to make sure you're providing what information investors need, and which is, of course, the purpose of these standards. And finally, we discussed reporting user confidence, especially in the current climate of greenwashing, accusations, and potential legal battles over public statements. It's increasingly important to ensure that your data is not only accurate, but that it's presented in a way that builds confidence among report users. And the reporting disclosure plan that we've been discussing through our exercises today, and which you can further develop through the homework handout, is something that's going to really help you to be clear and document those processes for reporting data needs to investors. Okay, so to wrap up, our final activity here is just thinking about some of those presentational techniques and navigation techniques we've heard about. We've heard some good ideas already, but maybe you have some more techniques as well that you can share with us that we haven't thought of. So I've posted that Menti is available to you already, and I see some people have been responding, but we'll just take a quick look together at those responses as they're coming through and just to see what's coming out from that. So I see lots of people have mentioned around having dashboards. Maybe those are good to summarize, key metrics and using charts to communicate information. Having clickable headers is definitely a good idea indeed to allow people to navigate through the different sections of the report and move around. Maybe having a list of contents, of course, and then a cross-reference and correspondence page. Maybe using visuals. Yeah, simple language, I think, is an important reminder because I know we can be guilty of it ourselves in this training. There's a lot of terminology to be used, and making it as simple as we can and using plain language in as many cases we can is definitely helpful. Or failing that, maybe having a glossary of some key terms as well. And so, yeah, I see lots of people mentioning visualization, presenting a clear framework with headings and contents and summaries, using bullet points. All great ideas, I'd say there. So thanks for sharing all of those, and definitely something to really keep in mind and to talk to your colleagues about as you develop your disclosures. I think you've really mentioned everything that we'd recommend, but just in general, I think keeping an idea on digital reporting, not just having a static PDF, but having something that's more interactive and navigable can be very helpful. Okay, so just to wrap us up now in Menti, I've got a final question to come back to you on. If you remember at the start of the session, we wanted to see where we were at in terms of our comfort, and probably just want to revisit that now and see if we feel like hopefully we've helped you to move a little bit further along that spectrum in these different areas. So take a moment and just let us know your thoughts on that. I'll leave that open and running, but I can see already the respondents who've come back are looking higher up that curve than where we started. So that's fantastic. And thank you all for the time and attention it's taken to get to that. So well done to you all. And I'm glad to see that improving. So I will leave that there for you. And then I'm just going to go back into our PowerPoint to cover a few final points. Okay, so we've talked a few times in the training about the homework exercise. And so just to recap on this, you can access this under the resources section of the event webpage, which we shared with you in the chat. And that homework exercise, it's not mandatory, it's totally voluntary if you want to do it. And you don't need to share it with us anyway. But what we encourage you to do is to take that away to help you to build out your thinking on the different points that we've discussed in today's exercises, and to help you to build that disclosure plan that's going to help you to really use the standards. So encourage you to discuss and share that with colleagues as well. And so lots of resources have been talked about today, of course. And just to say that although we provide as many hyperlinks as we can within the training materials, and the handout with the training materials with those hyperlinks can also be found on the event webpage where you signed up for the session and where we've shared the link to. There's a few key knowledge hubs to use as well that you can look to collate a lot of this information. So in particular, the IFRS Knowledge Hub, which you can Google, or you can see the link at the bottom of the screen there, is an excellent repository for a lot of information here. This is continually updated as new educational materials are developed. So we encourage you to continue to look at this as well and share with your colleagues. Of course, we have the two standards themselves. So just a quick reminder to always actually read the standards that you're reporting to. I think it's almost something that's quite easy to forget. So going back to those standards to really see the clear and specific requirements is of course recommended. And each of those two standards has an accompanying guidance to it as well. And then, of course, our colleagues, Chuck and Relitza, have joined us from the IFC. And of course, the IFC as well is another fantastic resource set to look to. So here with the Beyond the Balance Sheet programme, you have a hyperlink and a link on this slide to access this from the handout. There's loads of resources here that can help you across the full suite of sustainability, of corporate governance and reporting as well. So recommend definitely looking here too. And a final set of resources from us at the SSE as well, again, hyperlinked here to access the resources. We have guidance available, particularly on the ISSB standards. We have particular guidance as well on transition planning and climate disclosure. And finally, a gap analysis checklist for sustainability disclosure. And that gap analysis lines up with the ISSB standards, so that can certainly be a useful tool to help you in conducting that internal gap analysis. Okay, so we're very nearly there, and to say a big thank you and well done for all of you who stayed with us. We've had a fantastic rate of attendance and participation here today. So we know this is a long time to talk on an online call, and there's a lot to learn, but we're really appreciative of all of you who've asked your questions and interacted with us throughout the session. It's been fantastic to get all of your input. And as a merit for your hard work, you can now receive a certificate for completion of this course. So in order to receive your certificate, you will need to fill out the feedback survey, and Landon is going to share the link with you now in the chat to this feedback survey. So please look at the message from Landon with that link. So another option is that you'll also receive an email from Zoom 24 hours after today's training that will also provide you with this feedback link. So either take the link that's in the chat there or wait for the email that you receive from Zoom. And then once you fill out that feedback survey for us, you'll then be on the list to receive a completion certificate. And then please allow up to 7 days from filling out the survey for us to send us your certificate. So no need to contact us if you haven't had it in a day or two, because it will come if you just give us a week or so to do so. And once we've sent out the certificates, it's worth sometimes double checking also your junk folders to make sure it hasn't got caught in a spam filter. And if you know that your organisation has particularly strict policies around spam, possibly fill out the survey using a personal email address like a Gmail account, and that might help you to make sure you receive it too. So if you fill out the feedback survey, we'll then send you that certificate and you'll be able to share that with your colleagues and compatriots on LinkedIn. And so that's everything really to close us out. So just a few final words of thanks and appreciation. So firstly, a big thank you to all of the SSE supporters, the group of stock exchanges and other organisations who are really promoting and making this work possible. In particular, we'd like to thank our partners at the IFC. We had Relitza and Chuck joining us today, but the whole of the IFC organisation for their generous support to this programme. And finally, to the IFRS colleagues, particularly Bella and Robert for speaking today, and their colleagues Neil and Vanessa as well, who've done a fantastic job answering all of your questions in the background. So thank you to them for sharing their expertise with us here. And a big thank you finally from the SSE to all of you for joining us. We'll hope to see you again on a future training and wishing you the best for the rest of the day. We'll close the session there and thank you all again.